Welcome to the European Market Open, everyone. A minute to go into the start of cash equity trading. I'm Francine Lacqua in London with Tom McKenzie.
And here are your top stories. Below parity, recession fears and the energy crisis pushed the euro to a two-decade low. Stocks in the red, global equities continue to slide after their worst rout in 2 months. Plus, OPEC on alert. Crude gains after Saudi Arabia warns the alliance could cut production to support prices.
Tom, let's take a look at futures. We're seeing a bit of pressure across the board as traders thinking that the Federal Reserve will actually come up with some hawkish comment. All eyes on Jay Powell and that speech on Friday. For the moment, DAX futures, but also FTSE futures down 0.5%. So the focus, of course, is on this tightening monetary policy and what does that not only for growth, but global markets.
Yeah, the primacy, of course, of that speech. More hawkish commentary is expected, as you say, out of Jackson Hole. We look ahead to that speech on Friday from Jay Powell. You saw losses of between 2.6% on the NASDAQ yesterday, and of course there is options expiry and some hedge fund positioning as well to factor in to these markets, just adding to that uncertainty. But the pressure was extreme yesterday, and you saw, of course, a significant move in bonds as well as the equity markets. Currently you're seeing the FTSE 100 down 0.2%. We continue to watch FX as well, given the pressure particularly on the single currency and sterling that came through yesterday on the back again of King Dollar. Currently the FTSE 100 down 0.4%. Over in Spain, losses of 28 points, and of course that energy picture as well. And you saw that in Germany, 700 euros per megawatt hour or thereabouts. That's the first time it's gotten to those levels ever in Germany, compared to about 45 euros per megawatt hour last year. The futures in the US pointing to further losses then, building on the downside of yesterday, down 0.4%. Euro dollar again below parity, and we saw it cross through that level yesterday. The US 2-year, 10-year currently at 2.99. It crossed comfortably above 3% yesterday, currently just off by 1 basis point, 2.99. And Brent in focus again on the back of those comments from the Saudis, $97 a barrel, currently up 0.7%. We continue to watch what's happening in Iran as well. The US and the Americans saying there is some movement there in terms of those conversations with officials in Tehran.
Tom, this is what I'm looking at in terms of the markets on the move, or sectors are on the move. Let's go straight to the IMA. I love this Bloomberg function. You can actually type MAAP on your Bloomberg terminal. Energy, the only one seeing a bit of gains. This is also on the back of what we heard from the Saudi oil minister saying they could cut production because of the imbalance currently. So energy is up, everything else is down. Construction, technology, and auto parts down some 0.7%, and that's actually the lowest. So those are the industries that are losing the most. Let's get over now to our Bloomberg MLive managing editor. He is Mark Cudmore. Mark, good morning to you, and you're looking at German yields.
Yes, good morning, Fran. Of course, FX absolutely in focus, with euro dollar absolutely smashing through parity this week and continuing to slump today. It's really had a bad run, and one of the reasons, of course, is that while there's a massive energy crisis in Europe, it is a supply-side inflation problem, and that means it's very hard for the ECB to act. And that means the deeply negative real yields across the European continent look set to stay very, very negative. Now, this is German real yields as measured by the 2-year rate in Germany versus the headline German CPI print. So it's a slightly different way to do it, but kind of very much the real impact that many people feel. And as you can see, it's going back over the last 30 years. As you can see, we've really fallen into unprecedented territory over the past year, where Europe's had a real inflation problem. We've not had a proper reaction yet from the ECB, and CPI is just running away to the top side. And this means that in real terms, if you're buying German bonds, you're just losing money in real terms, hand over fist. And that's a real problem because Europe has a very, very large debt pile. And it is this backdrop which means it'll continue to stay extremely difficult for the euro for the rest of this year.
Okay, Bloomberg M Live managing editor Mark Cudmore also getting PMI out at around 8:30 for Germany, which will give us a clearer sense of just how badly that economy is faring on the back, of course, of that energy crisis. Let's get back to some of the key market drivers then. And joining us now is Beata Mante, Citigroup Global Equity Strategist, and Lynn Thomason here in the studio, our managing editor for EMEA Markets Editing. In terms of, let's start with what happened in the markets yesterday, Lynn. Let's bring you in at this point. The sell-off, is this conclusive evidence now that this was indeed a bear market rally?
Yeah, I mean, I think we've still got a ways to go before we can consider it a full bear market rally, but clearly the mood has changed, and, you know, it's just red across the board. I mean, I think the graph you showed earlier with energy really being the only sector up today, I mean, that just speaks to the big themes in the market right now.
So, Beata, good morning to you. Is it just foolish to fight the Fed right now?
Hi, good morning. Well, I think one thing that we have learned over the years is not to fight the central banks, right? And the reaction function of the market, if we do expect slightly more hawkish rhetoric from Jackson Hole, is plausible, right? So bond yields are going higher, and the equity markets, after the big rally that we've just had on the back of repricing the central banks to being less hawkish or more dovish, whichever way we want to say, well, it doesn't surprise me. Let's put it this way.
And yet, Beata, JP Morgan coming out and saying that the last big hike that you're going to see from the Fed is going to come through in September, and then they're going to start to ease off, and that's going to prove supportive for equities. What is wrong with that call from JP Morgan?
Well, that would be a great outcome if indeed the Fed stops hiking in September. We have a bit more hawkish reaction function of the Fed going all the way to 4.5% into the next year. But absolutely, more dovish central banks would be very, very welcome by the equity markets. But I think still there is a lot of worries that inflation is going to continue to be sticky, and perhaps the central banks have to hike as much as they can while they can before the recessionary environment hits us.
Yeah, 100%. Lynn, I mean, I guess this is why markets are maybe, you know, pausing ahead of that Jackson Hole speech by Jay Powell, is how aggressive can they be in this kind of environment?
Yeah, I mean, I think clearly the mantra from the Fed has been they're going to do what it takes to get inflation under control, and markets are now repricing, you know, that hawkish sentiment. I think, you know, the move you saw before was people starting to think things might be better than expected, that they'll start to pivot and be more dovish. But I think what you can see in the action of the past week, it's clearly the opposite.
And Beata, how do equity markets react to a new inflation dynamic if indeed we get to a point where we're never going to be back to 2%, where it's more like 4%, 5% in terms of entrenched deflation across these economies? What is the equity market reaction to that longer term?
I think we'll have to adjust to the new reality that it's going to be higher inflation for longer, right? And as long as the central banks are not going to stick to their lower than that inflation target, you know, some inflation, we've been longing for inflation for the last decade, right? Not as high inflation as we have, but if it stabilizes around 3-4%, I think it will be okay for the equity markets to take it in.
Beata, what are you buying right now? Is there anything that you trade with conviction?
So I am worried. Well, I wouldn't be buying into the rally. I worry that the rally has gone a bit too far. I'm bullish on equities over longer term. My targets are positive over the next 12 months, but the markets don't go up in straight line, right? So I worry that there is bad news ahead before the good news. So the portfolio is that I prefer the UK over the continental Europe. Within Europe, because I am more tilted towards value, and I think if there is this risk of more hawkish rhetoric from the Fed, from the central banks, then I would be particularly worried about growth, but growth cyclicals the most. So what I've done last week was to downgrade parts of growth cyclicals that have done very well in the rally. So industrials, retailing, I'm already underweight chemicals. So I do worry that if recessionary worries start hitting the market starts realizing them, these parts of the market have the most to lose.
Beata, what is the call on UK then? You mentioned that it's one of your preferred markets. At a time, of course, Citi coming out yesterday saying that inflation could top 18%, rates could get to 7% on the back of all the energy concerns, the inflation crisis here in the UK. Just unpack that call for us on UK assets.
Indeed, very fair point. But Tom, remember that the UK market, and I'm talking FTSE 100 here, really, is the most international market out there. So it's packed with big multinationals where 70% of revenues comes from abroad. So it's not really a bet on what is happening in the domestic economy, right? And it has been benefiting through the first half of the year because it has big weighting in commodities. And from what you've said before, well, they might continue to do well, right? But also what the UK has is big weighting in defensives, healthcare, consumer staples. These are all very big sectors within this region. And defensives are very expensive everywhere in the world. Many clients come to us saying, well, you know, it's just impossible to find any defensives that are still reasonably priced. The UK is the one place when you can find still cheap defensiveness. So that could help the UK call as well.
Great. We'll talk a lot more about the UK shortly. It's all playing out, Lynn, actually in currencies, right? Euro dollar breaking through 99. We saw that also level that we saw yesterday breaking through parity.
Yeah, absolutely. I mean, I think we spend so much time looking at equities, but really currencies are such an interesting story these days. I mean, they were boring and low volatility for so long, but it's just become such a microcosm of what's happening in the global economy. And you see the euro breaking through parity, lots of expectations that it's going to go lower, the pound yet again weakening, and you know the dollar's dominance continues to be the big force in markets.
Thank you so much, Arlene Thomason there, and joining us this morning. Beata Maithi, Citigroup Global Equity Strategist, stays with us. Now, coming up, also German Chancellor Olaf Scholz in Canada today, or actually yesterday, as his government works to reduce Germany's dependence on Russian gas imports. We'll have plenty more on that story next, and this is Bloomberg.
If you do any kind of business in this country, there's a pretty good chance that you're going to see that business registered in Delaware. Why? Because that's where you do it. And our point was Wyoming can be that venue for blockchain enterprise, for crypto.
It's not the Wyoming way to sit around and wait for change. We want that independence, we want that freedom, we want that individuality. And that's a common theme that brings together bipartisan support for this in Wyoming.
We want to make sure that people understand, especially in Wyoming, but as the United States as a whole, this trend is coming. It's not going to stop. This is more of a small town that's growing into what I would call the cryptocurrency version of Silicon Valley.
It's the philosophy of that rugged individualism, the independence, and the ability to really get things done for yourself and control your own destiny. You get that from a blockchain, and you don't get that without it.
The difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the Open, everyone. 13 minutes into the European trading day. Guess what? It's talk, of course, about inflation, about Jay Powell. Our Mark Cudmore earlier last week was saying it really is the only catalyst out there in August. And for the moment, we're seeing a bit of pressure on these European stocks, 0.2% lower.
I have you down when it comes to sporting wear as more of a Lululemon kind of girl, but maybe I'm wrong.
Or not at all.
Because
I'm going to cocktail.
There is a link here to Adidas and what's happening there. I don't know if you're a fan. So their CEO, the German sportswear maker, we're focused on one of our stocks to watch, Adidas. There's a surprise departure of their CEO, Kasper Rorsted. And Fran, you tell me on good counsel that it can be Adidas or Adidas.
So this one came straight from the chief executive who's now leaving. So I wonder whether because he was mispronouncing, he said, right, enough is enough. I need to find a new company. So now I'm questioning myself.
Maybe we've just hit on what is behind this mystery around the CEO departing. So that's Adidas. IAG, by the way, they are bad news for your winter holidays, cancelling 5,000, it seems, 5,000 flights over the winter. This is BA, of course, part of the IAG group. BT, another one to watch, currently getting 1.25%, saying regulators here are going to basically look past this increase in the stake by Altice, which has increased its stake in BT to about 18%. So just a couple of stocks to watch in the session today. Francine.
Now, German power has surged above 700 euros a megawatt hour for the first time as markets panic over the country's dependence on unreliable Russian energy supplies. Well, the Chancellor Olaf Scholz went to Canada as part of a push to find alternative sources of gas, and he also emphasized that his government is working hard to end its dependence on Russian gas.
We are working hard to become independent of this gas supply, and we are doing a lot of investments to make it happen, and we are doing it as fast as ever possible. Never such an infrastructure has been built in Germany in that a short time.
Easing the processes because of the difficulty that Germany is facing to make sure that we can move through regulatory hurdles more quickly is something we're willing to do. But there needs to be a business case. It needs to make sense for Germany.
Now, for more, we're joined from Berlin by Bloomberg's Birgit Jennen, our bureau chief in Berlin. Birgit, thank you so much for joining us again. How much does this actually help with the timeline of how fast some of the energy can arrive in Germany?
Well, the government is clearly at the moment looking at where is the energy need. And at the moment, I mean, we do hear that they seem to be on course unless, you know, Russia is cutting gas further. They do say that probably if the winter isn't getting too cold, they might get through this coming winter with the existing energy storage. But they are more worried what is going to happen in the next year and during the winter. And therefore they say they need to make sure now that in the medium term, in the next couple of months, they're gonna get LNG, for example, from Canada, or also extra gas from Norway. And they're also still in negotiations with Qatar.
Birgit, just before I get to my next question, just got to highlight some redheads crossing the terminal. Of course, this links into what's happening across the energy picture in Europe. In this case, we're talking, and we're waiting for the German PMI out at 30 minutes past the hour. But now you've got French August services PMI coming in at 51. So below the forecast of 53. That is going to be concerning for officials in France. That's services PMI for the month of August coming in at 51. So still in expansionary territory, but the forecasts have been for 53. Manufacturing PMI in contraction, 49. The forecast had been for 49. Again, that is for the month of August. Birgit, as we tie in the broader economics to what's happening in the gas picture and the energy picture across Europe, where is the urgency from policymakers when we're looking at 700 euros per megawatt hour in terms of German power prices? Long-term conversations with the Canadians is not going to be enough, is it?
No, I mean, they are looking at the impact, obviously, for the economy. You pointed out that Europe, obviously, is already facing the economic backlash, and Germany is at the border of recession. So what they are looking at is actually also to keep the balance right between the impact for the companies, so that the companies can still pay the rising energy prices, and at the same time also to keep basically on the one hand the public unrest under control, and also the burden for consumers. Therefore, the government is looking at distributing the burden. They have passed this surcharge, which is passing on up to 500 euros per family to the consumer, and we will see some further measures, also including further fiscal stimulus from the government.
Birgit, thank you so much. Birgit Jennen there, our bureau chief in Berlin. Now let's get back to Beata Manthi, head of European equity strategy at Citi. Beata, we're talking a little bit before about your biggest conviction. We talked about inflation in the US, and then we started talking about the UK. I know Citi really sent shockwaves, across trading room floors with that 17% call on possible inflation in the UK. Does that mean that you're, reworking a lot of your inflation forecasts around Europe as well?
In terms of the UK forecast, it is really much higher for non-core. So the conviction is that higher food prices, higher energy prices are going to hit non-core. But core inflation is much lower, right? It's around 6%. It's more in line with where consensus is. And the winter is coming, and of course, energy prices, as we've discussed before, continue to stay high, right? So you've got to imagine that there'll be inflationary pressures coming through into the winter.
Beata, analysts are expecting, 10% earnings growth this year, 5% next year? What is the earnings, the EPS contraction when we factor in this gas shock?
So this is one of my biggest worries, right? That earnings expectations definitely have to come down. So as you said, analysts are at +10, +5 for the next year. However, to be fair, if we exclude commodity sectors out of this 10%, it's a more reasonable 2% for this year, but 10% for next year, right? And if indeed, as Citi economists forecast, we are going to get hit by a recession in the Eurozone next year, that's far too bullish. So I think it could come to the negative number for this year. The pain will be concentrated around the winter months and quarters. Of course, year on year, we could see contraction of around 10%. A big EPS recession, it's around 30% contraction. So, this -10 can prove even overly optimistic.
Okay, -10 in terms of EPS, even that can sound overly optimistic. And a call there, of course, to upgrade telcos to overweight, particularly concerned about growth cyclicals. Beata Manthi, thank you, head of European equity strategy at Citi. Thanks for those insights as ever. Coming up, Saudi Arabia warns that volatility in the oil market may force OPEC Plus to cut output. This is a redhead across the terminal saying that the US retail gasoline falling to its longest run of decline since 2015. Just some good news there on inflation. We'll get the details around Saudi Arabia and oil next. Stay with us. This is Bloomberg.
China's appetite for energy is enormous. The country consumes about a quarter of the world's energy supply, 35% more than the US annually. Its energy needs have more than tripled since the year 2000. That consumption has helped to fuel astonishing growth, but it's come at a cost.
China is the world's largest greenhouse gas emitter. There is no way to tackle climate change unless China reduces its emissions to net zero.
The country's reliance on fossil fuels is also a hindrance to its own growth and the well-being of its citizens.
China is not energy secure. It has a massive import bill for things like oil and gas. It has a long-standing pollution problem, and it is also prone to outages that severely hamper industry.
All this has led the world's biggest polluter to take steps towards a radical transformation.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Welcome back to the Open. We are 24 minutes into the European trading day. Just recapping a couple of redheads that crossed the terminal. Important when it comes to anyone looking at the energy complex. So US natural gas prices hitting $10 for the first time since 2008. That is going to be linked to, of course, a surging demand, surging prices in Europe when it comes to gas prices. We saw those jump more than 10% just yesterday alone. And of course, German energy prices getting to above 700 euros per megawatt hour. The other component when it comes to energy, and this is at the pump in the US, so important when it comes to inflation, important when it comes to the politics of the US leading up to those midterms in November. US retail gasoline falling in its longest run of declines since 2015, Francine. That is important when it comes to the pressure on households in the US, the fact that gas prices now, at least petrol prices, gas prices at the pump coming down.
Yeah, and again, we're starting now to see a lot of pricing forward because they worry about the winter. And I saw one, which I have to say is absolutely terrifying. He's from Energy Aspects, saying that gas prices could rise 400 euros if flows via Nord Stream 2 stop in September.
There we go, the importance of what's happening when it comes to Nord Stream 2, and that's closing down at least for 3 days, according to the Russians, at the end of this month. The concern being that it won't come back online. Right, let's get to what's happening in Saudi Arabia then. Energy Minister saying that OPEC and its allies may be forced to cut output as the futures market has become increasingly disconnected from fundamentals. For more, we are joined by Bloomberg oil reporter Verity Ratcliffe. Verity, what are the details? What do we know?
So he was pointing to extreme volatility in the market, essentially saying that futures prices are swinging wildly whenever there's a change in sentiment, pointing particularly at any moves from Russia or signs of a global recession, which is, of course, the case. He also said that OPEC may need to make a cut, and that's already had a response from particularly Asian refiners who, of course, use that crude as a feedstock.
Verity, what does this mean going forwards, actually? Does it mean that we could see production cuts quite quickly?
Well, certainly he was talking about the next meeting of OPEC, and anything that Saudi Arabia says is looked at very closely as the most powerful member of the OPEC group. But he was saying that OPEC has the ability to cut. They never really give too much away before the meeting. But just the idea, raising the possibility that they might cut is certainly interesting after many, many months of having a rollover event basically at OPEC where it's predetermined and everybody sort of had an idea of what was going to happen next.
Verity, thank you so much. It's a bit of a whiplash effect. Verity Ratcliffe there looking at OPEC. Coming up, a market's brace for German PMI readings just in a few minutes. This is Bloomberg.
So the inflation environment has been changing a little bit. Inflation's been very low for 25 years. Now people think inflation's coming back. How are you going to deal with that?
I think many of the tools that we've historically used to battle inflation no longer work in the same ways they used to. I think people oftentimes thought of housing as a way, or especially retail and real estate as a way to hedge against inflation. Less and less possible the way we've invested in it. I think commodities similarly have been thought of as a way to hedge against inflation. There are challenges over the long term. Equities have been a hedge against inflation. We will continue to do what we have done in the past, which is build a diversified portfolio where there are many different opportunities that have the possibility of hedging against inflation, because different types of inflation have to be hedged in different ways. So if it's a very quick increase of inflation as opposed to a slow rise of inflation, is it temporary? Is it a long or persistent type of inflation? So for us, I never model myself an economist that can predict where inflation is going. And so what I need to do is build a diversified portfolio where there are different options that can fight the different types of inflation, and to pay close attention to it. And you know, fundamentally, it's done through the equity markets.
Really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. Below parity, recession fears and the energy crisis push the euro to a two-decade low. Stocks fluctuate. Global equities actually look for direction after their worst rout in 2 months, plus OPEC on alert, high alert, crude gains after Saudi Arabia warns the alliance could cut production to support prices. Now, things, Tom, are looking a little bit different in the markets. They were down, and now we're seeing slivers of green.
Yeah, a little bit of a turnaround in terms of the sentiment. Of course, you had a pretty significant sell-off yesterday in terms of the US markets, the SPX, the S&P down about 2%, the NASDAQ closing down 2.6%, largely on the back, of course, of that reversal of sentiment, hedge fund positioning, but high yields as well, particularly impacting, of course, tech. I think it's two really important stories, particularly when it comes to energy. Again, in focus for us today, we're looking at US natural gas prices, those getting to $10 for the first time since 2008. But at the gasoline, in terms of the pump, and this is important, of course, for households in the US and for the politics of the US, those prices at the pump coming back down to levels last seen in 2015. That will be important. So that's a boost for the Biden administration at a time, of course, when OPEC Plus are coming out and saying, look, we could cut back on output. In terms of how the market's shaping up then, the broader benchmark currently down 0.1%, as Fran was saying, turning around from the bigger shock that we were seeing in terms of the start of the session. Currently the DAX is just in positive territory, just up 3 points. The FTSE 100 down 0.4% as well. We'll switch it over, see how things are playing out across these sectors. Energy is in the green, as are autos as well. Basic resources, energy currently up 1% on the back of that stronger oil picture, again tying in to Bloomberg's conversation with the energy minister of Saudi Arabia and that threat there to cut production. Basic resources also getting 0.9%. A number of sectors still in the red, though, including food and beverages, media and healthcare as well. That is the shape of the sectors, at least 30 minutes into the trading session this Tuesday. Francine?
Energy up 1%. Now turning to the economic picture for Europe, concerns continue to mount. Tom, that's as the fallout from the war in Ukraine drives up energy and food costs. Now, as a recession or risk of recession hangs over the region, we're also getting those PMIs this morning, which are giving us a bit of an insight into the challenges facing the economy. Now, for more, we're joined by Lizzie Burden. Hi, Lizzie. So what have we learned so far, and what else are we expecting?
Well, Francine, we've already had the French data. It showed contraction on the composite PMI and manufacturing, but slight growth when it comes to services. We're still waiting for the flash composites for the Eurozone and the UK. Both will give us an indication of how much the soaring energy costs and the risk of Russia cutting off gas supplies will threaten a recession across Europe. We're expecting to see contractions in both Europe and the UK in August, and then Bloomberg Economics, looking ahead to the fourth quarter, is expecting recessions in both. Don't forget, in the UK, UK, consumer confidence is at a record low. We saw it in that GfK survey. It's at a level that's consistent with a recession already, and we're not even at the peak of inflation yet. But what I would point out is that our economists also say that a UK recession is expected to be milder than previous historic ones because we've got this healthy household balance sheet and also the expected substantial fiscal response. Our economists say that even if Liz Truss says that a recession isn't inevitable, it actually, despite the tax cuts that she's promising, is likely, though not to the extent that without her help.
Yeah, it's something of consensus now, isn't it? The UK is going to be adding or falling into recessionary territory if it isn't already there. The Eurozone as well. Many economists saying that is almost inevitable, a recession for the Eurozone. We're just getting that German manufacturing data. It's actually a beat on the forecast for the month of August. So manufacturing PMI coming in at 49.8, so still just about in contractionary territory, but the forecasts have been for 48, and I believe it's a beat on the July number as well. Interesting, of course, as we know, the industrial sector in Germany under pressure as a result of those very, very high energy costs that we were talking about yesterday. Services PMI, by the way, falling to 48.2. That was a big miss from the forecast of 49. But manufacturing, it seems to be holding up better than some had expected over in Germany. Lizzie, you were in Felixstowe yesterday at the glamorous location of Felixstowe Port. Day 3 of the strike there. Talk to us about what's happening, what the mood was on the ground, and whether or not there's going to be more industrial unrest, not just at Felixstowe, but beyond in the UK.
Really interesting talking to workers on the picket line, Tom. They said that they're going to stay there holding out until they get a 10% pay rise because, of course, we've got double-digit inflation in the UK. But, of course, we had that forecast from Citi yesterday saying that inflation in the UK could go above 18% next year. So I asked them, even if you got 10%, that would look meagre by the time we get to 2023. They said they'd hope to renegotiate in the new year. I should point out, though, that Citi forecast is perhaps a bit aggressive because it assumes that policymakers will do nothing. And there's a report on the terminal today by my colleague Joe Mays reporting that Liz Truss would at least do an emergency spending package. I don't know whether we'll call it a budget, but a spending package to help people with their energy bills if and when she took office in September.
Okay, Lizzie Burton, thank you very much indeed. Just to remind viewers, so that manufacturing PMI for the month of August out of Germany was actually better than forecast, but also as a beat on July as well. 49.8 for the month of August compared to 49.3 in July. And the euro just pairing some of its heavier losses on the back of that data, currently down around 0.2%, still below parity. Now, as we just heard, concerns for euro area economies continue to mount, and maybe this PMI data out of Germany assuages some of the more drastic concerns. It's having an impact on the euro, as I mentioned, currently trading below parity. And what is happening in terms of the dollar, King dollar, is a key factor in this when it comes to the euro, but also, of course, sterling and EM currencies. Jordan Rochester, Nomura G10 FX strategist, spoke to us earlier about the perfect storm that is engulfing the single currency at the moment.
It has been mostly a dollar story. Euro hasn't underperformed as much as I think it should. I think the FX market is totally mispricing the situation in Europe. The situation is a complete rethink of the economic model in the Eurozone. And it's strange for all of us to see the euro selling off so slowly. I think it should be much faster. We'll be testing 97.50 down towards 95 cents in the next few months.
Now we're joined by John Hardy. He's head of FX strategy at Saxo Bank. John, good morning. So going back to that German manufacturing PMI, a bit better than expected, but anything below 50 still indicates a contraction. What are currency strategists missing? I mean, we're heading towards a recession, and there's probably little way out of it.
Well, we've gone down pretty far, pretty fast. Let's recall we were trading up above 103 not that long ago. Down well below parity, yes, a slight beat on that. But if you look forward, of course, at these energy prices, these forward prices for power, for natural gas, we're talking about levels from what I'm reading and understanding that some companies are simply not hedging at these prices. Either the prices have to come down or production will stop to some degree. So that's the oblique outlook you have in Europe with this current shutdown of the Nord Stream 1 pipeline, et cetera. So yes, the Eurozone and the euro is beset with a very ugly menu of problems. And I see continued pressure there unless there's something very dramatic that develops on the U.S. dollar side of things, and I'm not seeing that. So this parity break could be quite considerable, and we're looking down towards the next big round levels, 0.95, even 0.90 if what we're seeing in the forward market for power, et cetera, if we realize those prices.
What would take it 0.95, 0.90? What gets euro to 0.90, John?
Well, that's when you have when you begin to have an actual shutdown of key parts of industry, a real crisis during the winter. This is not something I'm calling for. It's a risk. We do have hopes that the natural gas build is sufficient to keep Europe warm this winter, but actual manufacturing could be another story. And as your previous strategist indicated, you're talking about a redefinition, a rebuilding of the entire Eurozone growth model, particularly in Germany, which was unfortunately based too much on cheap Russian gas. That takes time. This is not something you accomplish over the course of a single winter. So this is a long-term issue. In the meantime, I think the U.S. dollar and the U.S. economy strength, we could see it just sort of rolling on for another quarter plus beyond what the market's expecting in terms of the timing of the recession, the timing of the inflation slowdown. And I think that's going to keep the dollar bid. The Fed is going to have to stay on message. Probably see that this week with the Powell speech, but as well, quantitative tightening, and that hasn't really even geared up to the pace that we need to see.
John, just going quickly back to the Eurozone. So our Bloomberg economist actually believes that the Eurozone can have a shallow recession as long as consumers are shielded toward, for the energy costs going up. Is that possible? Like if we have a much colder winter, does it actually stop the ECB in its track in raising rates?
Well, it's a cost of living crisis. It's a real slowdown. So it might be shallow or it may be short, but I'm not sure it's going to be that particularly shallow in terms of the real GDP impact. So it really depends on what the energy price looks like come spring. I think if you want to call this recession, and I'm simply not capable of telling anybody what that price might be, and that's going to be the determinant here.
When it comes to the pound, to sterling, John, yields up, and we saw that yesterday, and yet the pound continues to be hammered, trading, according to some, like an EM currency. Does it continue? What does it tell us about the state of the UK economy?
Well, it tells us about the state of the confidence in the pound, because it is, as you say, it's a very remarkable set of developments when you have the rates pricing in a tremendous, significant acceleration of the Bank of England's tightening plans, and yet the currency does not respond. I think it speaks to the set of issues facing the UK with the massive external deficits, with the new government coming on board, very populist program, not likely to shore up the fiscal situation in any meaningful way. The sterling is going to take the impact there. Just yawning external deficits. I don't see what improves the situation for the pound. And, talking about the euro, I think the pound is in an even worse situation. And we could be talking about parity sterling US dollar by the end of this winter if something doesn't improve in this outlook.
What's your call on euro sterling?
Euro sterling, sort of indifferent. If you will, I think sterling's issues are heavier. I think we could go a bit higher, but I'm not expecting drama in that pairing. But I would expect sterling to come out on the weaker side of that in the coming months.
Okay, John Hardy, head of FX strategy at Saxo Bank. The pound could get to parity with the US dollar by the end of this winter. Thank you very much for your takes. Coming up, Chinese banks are employing unusual practices to inflate their loan volumes. We look at what's driving that next, what it tells us as well about the vulnerabilities being baked into the Chinese economy. Stay with us. This is Bloomberg.
This week, as the world watches inflation rise, employment rebound, and fiscal policies react, all roads lead to Jackson Hole for the Kansas City Fed's 2022 Economic Policy Symposium. Bloomberg's all-star team is live as policymakers and financial insiders discuss the economic issues and solutions that keep the world's money moving. Coverage starts August 25th on Bloomberg Television and Radio.
Is it possible the industry is in an arms race that will lead to spending itself into an oversupply? I mean, that has happened before.
We've looked at this very carefully, and the digitization of everything. Tell me what aspect of your life, Emily, isn't becoming more digital?
Well, I'm trying to prevent that, but yes, I think it's happening.
And COVID has accelerated that. The industry cost $500 billion last year, the semiconductor industry overall, and estimates are $1 trillion, a doubling by the end of the decade at that point. I believe those estimates. It's not that there's not going to be some blips and turns on the way, and the majority of that is driven by leadership process technology, of which only 3 companies can satisfy that need.
No one covers the world like Bloomberg.
There's a sense it'll get to 7% in the coming months. Do you see that coming true?
There was something of a grey zone battle between Taiwan and China.
Where are the job cuts to come from? We will not just cut and run.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. To the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg.
Welcome back to the Open, everyone. We're 45 minutes into the European trading day. We're seeing gains that we didn't see at the Open about 45 minutes ago. The DAX now gaining 0.2%. The European stocks down 0.1%. A lot of people, Tom, are actually on holiday, which is, I know volumes are a little bit thinner. And really, it's all about Jackson Hole. And you have such a big speech from Jay Powell. Everyone's kind of a little bit in a wait-and-see mode, right? I feel in a wait-and-see mode. I'm like looking at tickets for Harry Styles or maybe a couple of football games. I look at the markets, but it's really Friday.
Wait, there's your entertainment news then. Harry Styles, football games. I mean, we're still befuddled by why you're a Chelsea fan, but we'll look past that.
They're playing Fulham.
Okay, all I care about is the fact that Arsenal are doing very, very well indeed. There we go. There's the entertainment news. Yeah, of course, we're looking ahead to Jackson. Is it a big surprise that we're expecting more hawkish commentary? There's going to be a pushback. The liquidity conditions have eased, right? Yeah. That's not a good thing for the Fed. Officials within the Fed have suggested trying to push back on this narrative that we're seeing from the markets that you're going to get a pivot. But JP Morgan saying the last big hike is going to come September. They're not saying it's the end of the hiking cycle, but the last big one, 75 basis points in September. Yeah. And then you're going to get an easing off, and that's going to prove supportive, the bulls at JP Morgan.
Yeah, what I love is also Javier Blas has been talking about the energy story on Twitter and also here all the time, and it feels like the market are finally clocking up to the fact that there is something that will happen in the winter, especially if we have a very cold winter, and so those prices are just going through the roof in the middle of August.
Javier Blas is essential reading on oil and what is happening with this energy crisis. And there's an energy crisis in China as well, but we're going to be talking about what's happening in terms of real estate and in terms of the demand for loans. The energy crisis, by the way, hitting Sichuan. In China, some banks are inflating loan numbers as they struggle to meet government demands. Inflating demands to pump more credit into the economy. It's an intriguing story. It tells us a lot about what is happening in that economy. Let's bring in Bloomberg senior editor for Greater China Finance, Jonas Bergman, in Hong Kong. Jonas, what is driving this inflation then of the numbers out of banks? They're kind of fiddling the books for the regulators to try and show that there's demand for loans when maybe there isn't.
Well, they're certainly being creative. It's an interesting development. Chinese banks are caught in a very tight spot right now. On the one hand, as you said, the government is banging the drum for them to lend more to get the economy going, while on the other hand, they are finding very few companies to want to take out loans given the uncertainty in the economy. So bankers we have spoken to say that a certain window dressing is going on, with lenders doling out loans and then taking back those funds, basically paying the same rate demanding the same rate on loans and the deposits. So with credit growth, credit increase last month hitting a 5-year low, it's credible that in fact those numbers were even more dire than they showed.
So, Jonas, what are the risks actually of this approach?
Well, given the banks are currently also dealing with a major property crisis, big rises in loan losses, Certainly, and narrowing margins. So certainly these types of activities is not going to help that. There are also in China a lot of smaller companies clamoring for financing, which are, and banks tend to be, the big banks in China tend to be fairly conservative. So these smaller companies, millions and millions of them, are being forced to pay rather high rates outside of the, the regulated or more in the non-banking market. So there's a lot of risks for the Chinese economy coming up, and just this sort of window dressing is probably not the best right now for any party in the economy, really.
Jonas, thank you so much. Jonas Bergman there in Hong Kong. So we'll have plenty more, of course, on China. One of the most interesting, probably, stories that we had in August, and that surprised by PBOC that they did so little about 2 weeks ago to support some of the households, or actually real estate. Coming up, shares in the world's second biggest cinema group, Cineworld, continue to plunge. Coming up, we look at what's next for the troubled, very troubled company. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to the Open. We are 52 minutes into the European trading day. You're seeing a bit of an adjustment in terms of sentiment after that significant sell-off that we saw on Wall Street yesterday. You're essentially just down about a little under 0.1% across the European benchmark, but futures stateside have turned around. US futures, S&P minis pointing to gains of a little over 0.1%. A similar picture for the Nasdaq, of course, which sold off more than 2.6% yesterday. The euro as well, pairing some of the earlier losses to currently trade still below parity at 9.936, just down 0.1% after some manufacturing PMI for the month of August out of Germany came in better than expected, though still in contractionary territory. Right, let's take a look at the events today, other events that we are watching this morning. We're going to get more PMIs from Europe. We've had France and Germany, with the Eurozone at 9 a.m. London time and the UK at 9:30. Then at noon, here in Europe, the focus continues to be with Fabio Panetta speaking in Milan. At 3 p.m, after the US markets open, we're going to get new house sales data, painting a clearer picture of the state of the US economy in the last month, amid some pretty decent reporting from Bloomberg around the drop in house prices in some of the hottest markets there.
Yeah, it's good reporting. Elsewhere in the U.S., primary elections in Florida and in New York. Later tonight, we'll hear from Minneapolis Fed President Neil Kashkari as he speaks at a Q&A session at the Wharton, Minnesota Alumni Club. And finally, the German Chancellor Olaf Scholz will share a platform with the Canadian Prime Minister Justin Trudeau on day 2 of his 3-day visit. The focus, of course, energy, with Scholz looking to diversify Germany's energy supply. Right, let's talk also about Cineworld. Shares in London-based cinema chain Cineworld dropping again today after an 80% drop last week. Now, the firm said it was considering a voluntary Chapter 11 filing in the U.S. as it seeks to cut its $5 billion debt pile. Now, joining us now is Bloomberg's Thomas Hill. Thomas, thank you for joining us. I mean, we've been chatting, off on Cineworld, also maybe trying to get some bargains to go to the cinema. That's not happening. But what exactly is this company? Like, why is it in such bad position?
They had a very bold strategy in the years heading up to the pandemic. They borrowed extensively to acquire Regal in the US, which, built them an empire, made them the second biggest chain in the world. But that had them at a high a high multiple, and no one plans for a zero revenue outcome, but that's what they faced. And now, after extending many lifelines, negotiating with landlords, negotiating with lenders, waivers, they're sort of running out of road, and they're looking at voluntary.
So that debt pile has come back to haunt them after the pandemic. What is next then for this company? Do they they go through bankruptcy, they do Chapter 11, do they then become a takeover target? What happens with their assets? How do you see this unfolding?
Yeah, I mean, loads of questions, and we're going to have to do some reporting and see, but if they do carry through with the Chapter 11, there'll be protracted talks with creditors. They may end up taking control of the company, and then they've got new owners already that will see what they want to do. That will raise questions over jobs, over sites, and over the strategy, which some have criticised even before the pandemic. So these processes can take months, even years. So we'll wait and see. They criticised the film slate this year, Cineworld, and that's another reason why they believe that this has come sooner than maybe they expected. Not many big summer blockbusters this year.
Yeah, and there's that continuing debate about those big movies going straight to streaming versus being released into the cinemas. But a bold strategy, sometimes these pay off, and in this case, it hasn't.
They could have looked like geniuses.
Is that your call for the movie to watch?
That's it. That's my call.
There we go.
Good luck.
Thomas Seal, thank you very much on the plight of Cineworld, and we'll continue to watch that story for you as well. In terms of the markets, let's quickly check them before we get to break. Currently across the benchmark, you're down just a little under 1/10% here in Europe, but futures, as we mentioned, in the US, pointing up now. S&P E-mini is up 0.2%. Similar picture for the Nasdaq as well. Euro still at parity, but at 99.33, just down 0.1%. A little bit of a turnaround in sentiment after the heavy selling in the US yesterday. Stay with us. That is it for the European Market Open. Surveillance Early Edition is up next. This is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in, The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
I don't think it needs to be part of the cure. What we've experienced, if we let inflation build up over time, like in the 70s, it was 7 years of higher inflation. If we nip it in the bud, which I still think we can, then you don't have to have these negative effects that people worried about.
We are working hard to become independent of this gas supply, and we are doing a lot of investments to make it happen, and we are doing it as fast as ever possible. Never such an infrastructure has been built in Germany in that a short time.
Canada can and will position itself to be a key supplier of energy to the world.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Below parity, recession fears and the energy crisis push the euro to a two-decade low. Stocks in the red while global equities continue to slide after their worst rout in 2 months. Plus, OPEC on alert, crude gains after Saudi Arabia warns the alliance could cut production to support prices. Now, we did see a bit of a reversal. Nothing huge, but a bit more support on the markets that we did certainly at the start of the trading session an hour ago. We're also getting euro area August manufacturing PMI coming in at 49.7. It's a touch better than expected, mainly supported by Germany. But again, anything below 50 means there's still a contraction. If you look at services PMI, that's falling 50.2, so that's actually worse than expected. Now, the picture across the board for European stocks, pretty much unchanged. Again, traders really bracing from a lot more hawkishness from the Federal Reserve. We'll hear from Jay Powell a little bit later on Friday. S&P futures now gaining some 0.2%. We were speaking to Arlene Thomason, and really one of the things that we need to spend a lot more time on is a currency. Yesterday we touched parity, currently at 199.31, and this really goes back not only to energy supply in Germany, but also dollar strength, king dollar, and what that happens, or what happens with that next 6 months. The 10-year yield at 3.0109. Again, if you look at the change in the markets, and we'll get, I think, to the map shortly, it's very clear that the markets are expecting a lot of a hawkish stance from the Federal Reserve. Maybe not something that was priced in, but certainly energy shares amongst the only industry group today making some pretty big gains. This is also on the back of Saudi Arabia oil minister saying that they could cut production. The UK, you can see the FTSE down 0.2%. So markets awaiting clues on how hawkish the Fed will be as central bankers gather this week at Jackson Hole. We spoke to Stanford University economics professor John Taylor, who's at the very first conference 4 decades ago. Well, he says the Fed should be more communicative about where policy has to go.
I'd say 5% is where we should aim. That is not high by historical standard, that's for sure. You remember what it was in the 70s, but it could be higher. I wouldn't say absolutely 5. If inflation doesn't come down, then it may have to be higher. But I think inflation will come down, and we can stick it at a level like that. But let's get there first.
Now we're joined by Morgan Deladon, Head of Investment Strategy for Europe at Global X ETFs. Morgan, thank you so much for joining us. A lot of the focus is actually on equities, but it's all playing out on currencies. Like, what are the forces that could push at some point dollar to stabilize somewhat?
Well, actually, the euro dropping below parity is quite of a signal that the markets are expecting more hawkishness from the Fed. But one thing that should stabilize the pair would be more hawkishness from the ECB as well. Because when you look at headline inflation in Europe, core inflation in Europe, they're all trading higher, trending higher. And that is likely to trigger some more hawkishness from the ECB. And that should stabilize the pair.
So how hawkish are you expecting the ECB to be, despite some of these concerns, of course, about even a protracted and ugly downturn if energy prices go much higher?
I think for the ECB, the key input to inform their decision in terms of the size of the hike will still be core inflation in the near future, because when you look at services inflation, it's trending higher. So I do think the ECB might go for another 50 basis points increase. And that is something that is not currently priced in, because the market is more focused on the downturn on the economic side. But given the energy crisis in Europe, I do think that inflation will probably be more in focus at the ECB than actually the economic data.
Inflation definitely in focus everywhere because of the cost of living crisis. If there's enough support fiscally from countries, can we avoid the worst of a recession?
It's really hard to say. I think at the moment the stagflation scenario is becoming the most likely scenario in Europe, and that could happen actually before the end of the year. So stagflation is the main risk. Fiscal side can be countercyclical, but at this point in time, given the inflation data, it seems that it's pretty unlikely to have anything on top of what's already agreed on.
So, Morgan, overall, what are you most, when you look at the markets, what do you think is most being mispriced?
Well, this disconnect between, headline inflation and core inflation is something interesting I'm looking at. Because when you look at headline inflation, there is a likely risk that the market is seeing the Fed to remain hawkish. But headline inflation may have already peaked in the US, whereas we are probably quarters away from a peak in Europe. So this disconnect might trigger more hawkishness down the line from the ECB than the Fed. So yes, the market may have priced this dovish pivot early, prematurely, but perhaps by not too much.
Morgan, we have a great chart actually looking at what we're seeing in terms of energy and the fact that some of the energy panic is really also hurting Europe. But Valerie Tetel there putting some great charts together on the back of those flash PMIs. When you look at natural gas, power and coal, like this kind of chart, should traders, take action more than they have so far?
Well, this chart, it definitely shows the challenge from the ECB, a bit of a catch-22, where the ECB is trying to cap inflation. So far, the control over headline inflation has been complicated because it was mostly driven by energy prices. It could be still the case, but something that is also growing is the core inflation. So the ECB, that is the reason for the ECB to continue to hike interest rates despite some downturns. But all of these rise in European energy prices is saying that, yes, the peak headline inflation may be quarters, maybe for spring next year.
Morgan, thank you so much. Morgan Deladon there, Head of Investment Strategy for Europe at Global X ETFs, staying with us. Now, coming up, the German Chancellor, Olaf Scholz, visits Canada as his government works to reduce Germany's dependence on Russian gas imports. We have more on that story next, and this is Bloomberg.
This week, as the world watches inflation rise, employment rebound, and fiscal policies react, all roads lead to Jackson Hole for the Kansas City Fed's 2022 Economic Policy Symposium. Bloomberg's all-star team is live as policymakers and financial insiders discuss the economic issues and solutions that keep the world's money moving. Coverage starts August 25th on Bloomberg Television and Radio.
If you do any kind of business in this country, there's a pretty good chance that you're going to see that business registered in Delaware. Why? Because that's where you do it. And our point was Wyoming can be that venue for blockchain enterprise, for crypto.
It's not the Wyoming way to sit around and wait for change. We want that independence, we want that freedom, we want that individuality. And that's a common theme that brings together bipartisan support for this in Wyoming.
We want to make sure that people understand, especially in Wyoming, but as the United States as a whole, this trend is coming. It's not going to stop. This is more of a small town that's growing into what I would call the cryptocurrency version of Silicon Valley.
It's the philosophy of that rugged individualism, the independence, and the ability to really get things done for yourself and control your own destiny. You get that from a blockchain, and you don't get that without it.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
Yes, it's about renewables.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, German power has surged above 700 euros a megawatt hour for the first time as markets panic over the country's dependence on unreliable Russian energy supplies. Well, the Chancellor Olaf Scholz went to Canada as a part of a push to find alternative sources of gas, and he emphasized that his government is working hard to end its dependence on Russian gas.
We are working hard to become independent of this gas supply, and we are doing a lot of investments to make it happen, and we are doing it as fast as ever possible. Never such an infrastructure has been built in Germany in that a short time.
Easing the processes because of the difficulty that Germany is facing to make sure that we can move through regulatory hurdles more quickly is something we're willing to do. But there needs to be a business case. It needs to make sense for Germany.
Now, for more on all of this, we're joined by Bloomberg's Anna Shizerskayeva. And I'm sorry, I butchered your name because it's a Tuesday in August. I will get it right, I promise. Anna, what alternatives do Russian gas actually does Europe have in the short term and longer term?
Well, indeed, in the short term, Europe's alternatives are quite scarce because it has to get LNG from the market, available cargoes that are already being produced. So it's up to the companies if they're able to supply these molecules to, for example, these LNG terminals that Germany is trying to set up. Now, longer term, it is possible to get new supply that's slated to come online after 2025. But as we've seen with Canada, for example, Germany is desperate in trying to secure the fuel from all available sources. Canada is quite tricky. On paper, you have East Coast of Canada quite close to Europe, just a few days of shipping. But the gas fields are on the West Coast, so it's very difficult to bring that gas from west to east. And there's been a lot of projects to build LNG plants in Canada for years, and none of them have moved so far. So we'll see if Germany's interest will push them forward. But as Trudeau said, it remains to be seen if there's a business case to actually build these LNG plants. And Germany's talks with Qatar are still ongoing. They're difficult as well. So it just shows it's not an easy task for Europe.
So, Anna, is there any ceiling to prices?
There's no ceiling actually, because we see prices are now already more than 10 times higher than seasonal average for the summertime. And Energy Aspects said today that prices could go to 400 euros a megawatt. That's about 20 times seasonal normal for this time of the year if Russia cut supply completely in September. Now, the Nord Stream pipeline is going to be shut for 3 days from the 31st of August. And the risk is that the market is concerned that the pipeline will not come online after the maintenance. And so prices could surge higher if that happens. Now, the ceiling might come from demand destruction, because at these high prices, we're already seeing industries are suffering and output is limited. So we see the remain of these very high prices on industries, in particular, a chemical industry, in particular in Germany as well.
Anna, thank you so much. I'm going to try not to mispronounce your name. If I actually get it wrong, I'm going to pay you in megawatts, which will make you a rich woman in like a week. Anna Shirovskaya joining us on the very latest for energy prices. Now we're back with Morgane Deladon, Head of Investment Strategy for Europe at Global X ETFs. Morgane, we talked a little bit about, of course, the energy price. Again, it seems that when you look at equities, and I guess the problem with energy is that it's used for making everything. If you're making, for example, glass in Germany and the price goes up, you may also be shut down. Are the markets realizing this? Like, what exactly is priced in?
I think it's starting to realize it, because we are seeing headline inflation fueling into core inflation now. So we are seeing this pass-through effect. Now, in terms of equities and activities, we do see that there is a slowdown and a contraction now in Germany that will lower the gas demand and maybe reduce some of the demand and therefore some of the pressure on the price down the line. But there is still a risk in the short term because of the capacity of building reserve before winter in Germany seems quite challenging, despite lots of effort to try to see alternatives. So in the short term, I think there is still some options. LNG, we mentioned it before, but also like nuclear. There is also a chance that Germany reassess its view on nuclear power if there is a risk to the economy. So nuclear in Europe has been actually one of the first option for some other countries, the UK, France, and that could be something for the short term. Down the line.
So Morgane, talk to me a little bit. Yeah, down the line, finish your thought.
Yeah, down the line, it's more looking at investment in clean energies, renewables, and hydrogen.
Yeah, Morgane, what does it mean for the UK? So we had this pretty incredible call by Citi saying inflation could hit 17%, really mainly because of cost of living crisis due to this energy.
Well, in the UK, on top of having an energy crisis, you also have a Brexit effect, and the UK imports a lot. So there is still maybe in terms of the stagflation scenario, it's even bigger in the UK compared to continental Europe. That is for sure. But in terms of projecting inflation, it's really hard to say because there are lots of moving parts on the energy side, and it will all depend on what is the solution in the near term. Do we increase nuclear capacity, or are we reducing demand?
All right, Morgane, thank you so much for joining us. Morgane Deladon, their Head of Investment Strategy for Europe at Global X ETFs. Now, coming up, full coverage of the Jackson Hole Summit. We'll bring you top interviews and analysis. Of course, it's all about the currency market, so we'll look into that. The euro dollar yesterday below parity, currently at 90, I think about 91. Where's next? This is Bloomberg.
appetite for energy is enormous. The country consumes about a quarter of the world's energy supply, 35% more than the US annually. Its energy needs have more than tripled since the year 2000. That consumption has helped to fuel astonishing growth, but it's come at a cost.
China is the world's largest greenhouse gas emitter. There is no way to tackle climate change unless China reduces its emissions to net zero.
The country's reliance on fossil fuels is also a hindrance to its own growth and the well-being of its citizens.
China is not energy secure. It has a massive import bill for things like oil and gas. It has a long-standing pollution problem, and it is also prone to outages that severely hamper industry.
All this has led the world's biggest polluter to take steps towards a radical transformation.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
If they move in a way that's anticipated, another maybe 75 basis points, the next one, we don't know. There's some discussion about that. Then it will indicate that they're on the way. And I think what's most important now, and we've learned from history on this, learned from experience, is the more the Fed can communicate what its objective is. It would like to get back to 2% inflation. It needs to do this by a monetary policy that reduces inflation. It doesn't reduce the growth of the economy, reduces inflation, the better off we'll be. So that communication, that stipulating about what the policy will be like is very important right now, and I hope the Fed does that.
John, when it comes to where we're at in the markets, we're seeing extreme bullishness, not so much today, but we've seen the rally just continuing to build. Over the years, for you, what role have financial conditions played, and should the Fed be paying more attention to this, or at least allude to that fact, in order to sort of bring down this bullishness that we're seeing?
Well, they have to pay attention to the markets, obviously. They have an impact on the markets, and the markets have an impact on them. But I think that the more they are deliberative of this is what needs to be done, this is what's worked in the past, this is how we can do it, the more convincing it will be. And I think what the markets don't like is uncertainty about what's going to happen. There was more uncertainty today. I think that's one of the reasons why the markets went down. But the more that the Fed can indicate where it needs to be going, that's why these rules, so-called Taylor rule, whatever you want to call it, are advantageous, because it says, hey, we need to move a little bit further, and hopefully that will cure the problem more rapidly than people expect.
John, when you wrote about this in 1982, you flagged the scenario, right? Early deceleration, risking the issue around credibility, and then the risk of really disinflation causing a recession. Given perhaps some of the policy errors before, does that mean we're at a point where recession is going to be maybe a likely cure for this bout of inflation?
I don't think it needs to be part of the cure. What we've experienced, if we let inflation build up over time, like in the 70s, it was 7 years of higher and higher inflation. If we nip it in the bud, which I still think we can, then you don't have to have these negative effects that people worried about. They're right to worry about because they've seen in the past, but the more that there can be a stipulation, this is what we need to do. This is good monetary policy. This will make the economy healthier. This will make a stronger growing economy. It hasn't grown that well recently, grown it even faster, and I think that's what we should emphasize. This is better for jobs. This is better for the economy. This is better. And also, I would mention the world economy. We have inflation all over the place right now.
Well, that was Stanford University economics professor John Taylor. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Saudi Arabia's energy minister says OPEC and its allies may be forced to cut output as the futures market has become increasingly disconnected from fundamentals. Prince Abdulaziz bin Salman told Bloomberg harmful volatility is disturbing the basic functions of the market. OPEC Plus meets next month to consider production targets. Now, British Airways says it's scrapping about 5,000 return flights in the coming months. That is after cancelling about 13% of its summer schedule due to a staffage shortage and extended capacity curbs at its London Heathrow hub. BA says passengers who have been affected can rebook alternative flights or even seek refunds. Now, Dr. Anthony Fauci, who became a household name during the pandemic, is to step down at the end of the year. The top U.S. infectious disease expert has run the National Institute of Allergy and Infectious Diseases since 1984, advising 7 presidents on every major infectious disease outbreak since the HIV crisis. The 81-year-old says he's leaving to pursue the next chapter of his career. The U.S. has warned that Russia is preparing to launch intensified strikes against Ukraine's government facilities in the coming days. This comes after President Vladimir Putin called the car bomb that killed the daughter of an ally a, quote, dastardly crime. Ukraine is preparing to celebrate Independence Day tomorrow, which also marks 6 months since Russia's invasion of Ukraine. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Coming up, millions of Angolans will head to the polls in the oil-rich nation this week while we speak to the country's central bank governor. That's coming up next, and this is Bloomberg.
Possible the industry is in an arms race that will lead to spending itself into an oversupply. I mean, that has happened before.
We've looked at this very carefully, and the digitization of everything. Tell me what aspect of your life, Emily, isn't becoming more digital?
Well, I'm trying to prevent that, but yes, I think it's happening.
And COVID has accelerated that. The industry crossed $500 billion last year, the semiconductor industry overall, and estimates are $1 trillion, a doubling by the end of the decade at that point. I believe those estimates. It's not that there's not going to be some blips and turns on the way, and the majority of that is driven by leadership process technology, of which only 3 companies can satisfy that need.
The difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg.
Well, below parity recession fears and the energy crisis pushed the euro to a two-decade low. European stocks and U.S. futures waver on rate jitters. Traders brace for hawkish Fed speak at Jackson Hole. Plus, OPEC on alert while crude gains after Saudi Arabia warns the alliance could cut production to support prices. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, we're just getting some UK data shortly. Of course, all of the talk is on that Citigroup note yesterday saying that inflation here in the UK, if you assume that energy prices go much higher and so the cost of living crisis is getting much worse, inflation could hit some 17%. A 17% inflation, given the Bank of England for the moment sees inflation peak at 13.3% just before the winter. It begs the question, of course, what does it mean for their interest rate peaking? I mean, are we looking at 6%? Are we looking at 7%? What does that mean for mortgage? I mean, if you look at mortgages and how much people, of course, are dependent on that, we could see a real crisis in the UK. All right, we're just getting those figures out in the UK. August manufacturing, 46. The forecast was for 51. So it's much worse than expected for manufacturing. Again, anything below 50, and we're at 46 is a contraction. Now, August services PMI falling to 52.5. That's a touch better than expected. The other story, of course, weaker pound, and you kind of just wonder what that endpoint is. Now, we earlier had some euro area PMIs declined. They declined for a second month, according to new PMI data just out. Now, they signal that fears of a recession may already be coming to pass as record inflation saps demand and weakness seeps into more and more sectors. Joining us now to break this down for us is Lizzie Burden. Lizzie, first of all, that UK, good morning, manufacturing much worse than expected.
Yes, but you've still got growth in services and on the composite. It's the same as the Eurozone looking ahead, though. Bloomberg Economics reckon you're going to get a recession later in the year. You've already got consumer confidence at the level that's consistent with a recession. And what I would also point out is, just looking ahead, our economists reckon that the UK's recession will be milder than previous ones because you've got healthy household balance sheets, because we're expecting this fiscal stimulus from whoever is the next Prime Minister. But even, Liz Truss is saying that a recession isn't inevitable in the UK. Our economists say that all she can do is cushion the blow because it is coming. So the figures, I think, will get worse later in the year.
Yeah, I mean, that Citigroup note yesterday, though, was like really terrifying reading. I mean, I sent to everyone I knew saying like, oh my gosh, interest rates at 6-7%. Everyone was like, wait, what does it mean for my mortgage? What's the picture like in Europe?
So we've had a slew of data this morning. Let me start with France. It's slumped to the lowest level since that disruption earlier in the pandemic, unexpectedly. Germany, though, has contracted again, but that was what we did expect because of its comparative higher reliance on Russian natural gas. More broadly across the Eurozone, there's contractions driven by manufacturing, but also you're seeing services like tourism grinding to a halt, again, because of the inflation impact. So a lot of data, but it heralds a difficult run into the end of the year for European economies. Analysts surveyed by Bloomberg do expect a recession. And again, it's a headache for the ECB because they're expected to continue hiking rates, even though the economic momentum is fading.
Yeah, and it's all happening on currencies. Thank you, Lizzie Burden, there with the very latest on the UK and European economies. Now, millions of Angolans will vote this week in a key election for the oil-rich nation. Angola's ruling party, in power since the country's independence in 1975, faces its toughest test yet against a rejuvenated opposition. Now, we're joined by Angola's central bank governor, José de Lima Massano. Thank you, Governor, for joining us in, of course, Bloomberg Surveillance today. Now, if you look at what some of the region as a whole, Africa has been particularly vulnerable to high food and energy prices. What can your central bank do to actually insulate Angola?
Hi, good morning, and thank you so much for having us. So to us, a pleasure to be here. But as far as inflation is concerned, Angola, as you know, has been through a very demanding reform program. And ahead of the program here from our side, the central bank, we are also conducting a very restrictive monetary policy to ensure that we have prices at a stable level. And throughout this year, we are witnessing that prices in Angola are falling. Actually, we start the year with inflation around 27%, and today is 21%, and we expect by the end of this year to be below 18%. So the initiatives that Angola have taken in recent past, with all the reforms that we have introduced, and also including the ones related with local production, where we have seen also an increase of food in the market, I think is helping. So today, Angola keeps on importing quite a lot. On a monthly basis, we are importing something like $200 million of food. Has been reduced. If we look to 5 years ago, it was $250 million. So increase our level of production, restrictive monetary policy is helping Angola to contain inflation.
I mean, your inflation target is 18% for 2022. How much do you have to increase actually the price? How much do you have to increase interest rates to make sure that you hit that target?
We are okay, because today our basic interest rate is on 20%, and actually as inflation is falling, we expect also interest rates to follow the same trend. So we are not under any sort of pressure to increase interest rates. Actually, we're going the other way around. As inflation is falling, we'll see in Angola also interest rates falling and offering more chances for local production to keep on flourishing.
So you're not expecting to hike rates. I think your next policy meeting is September 26th.
No. We are meeting now in September, yes, and we are not anticipating any increase on interest rates. Actually, in the last monetary policy meeting, we made a decision to reduce rates, and we expect that if things remain with the same trend, now in September, we may see again interest rates falling.
I know Angola's debt burden has been falling, but I think you still owe about $19 billion to China. There's now talk about China waiving some of their debt to certain countries. Is Angola one of them?
Well, the Ministry of Finance is taking care of that. When it comes to external debt, I think the good news about Angola, as far from China, is that Angola is diversifying its sources of finance, and which is quite helpful. But then the Ministry of Finance, in our case, is the one dealing with China when it comes to external debt management, not the central bank.
But do you think there's a clear strategy for Angola to continue on the path to basically not sever those ties, but certainly diminish those ties with China?
Yeah, I think that Angola has to be open and has to keep on looking for opportunities. But the initiative that the country has been done in the last few years, and it also includes some of the reforms that we have introduced here in the Central Bank of Angola, where on the foreign exchange market, for instance, we remove all the bottlenecks that we used to have in the country. So today, it is no longer require any sort of licenses to import or export funds into the country. So it makes the markets more flexible, viable, and again, to us to have different and alternative ways to get finance. I think it helps.
I have to say your currency is pretty incredible, gaining more than 20% against the dollar this year since early 2022, which is one of the best performing currencies in the world. Will you continue to keep it free floating, or will you try and safeguard some of your exchange reserves?
No, we will just let it free floating. And the thing is that in the central bank, we are concerned with reserves, international reserves management. So we are, our target is 10 months cover of imports of goods and services. We are currently around 8 months of coverage, and so still below our target. But we are not anticipating the need to intervene in the markets. We just let the market function the way it is. It's working just fine. So today in Angola, you don't have people waiting for opportunities to make payments abroad, coming and seeking the central. It's working fine, for instance. It's working fine. So,
Governor, what's behind the strength of the Kwanza?
I think, well, one is the monetary policy that we are conducting being restrictive, because in the past we used to have a very expensive monetary policy in Angola, and all the public inefficiencies at the end of the day, and the need to additional finance were supported by the central bank. So it's no longer the case. We have a far more restrictive, more disciplined. Actually, one also has to be fair on the fiscal side. We can also see the efforts that authorities are making that, but on our front, it's far more disciplined. Then you also, Angola is an oil-commanded economy, so with the high in oil prices also helping the market, so the offer of foreign currency in the market to the market has also increased. And also one has to recognize that all the initiatives to increase local production is also bearing results. So we are importing glass, which means that the currency has also taken benefit of those developments.
Governor, I want to talk to you about banks and the banking sector. You have 25 banks in the country, but I think 5 of them actually have the main market share. Are you expecting M&A and consolidation in your country?
Yes, we do. Actually, we have recently made a decision to increase the minimum capital requirements in Angola once again. It will come in force now in October. Yeah, but also we are witnessing that some of the banks, it's not just a requirement for additional capital, it's that Angola has reformed the financial sector, and we have adopted most of our recommendations that are followed by European banks. So this is one of our preferences. So with all those reforms, the market is becoming far more demanding for commercial banks, and we are expecting mergers. But also we have already seen some of the banks go into the stock exchange. So one of the banks has already
I saw one, right? Yep,
yes,
that's BAE, Angola's biggest private lender. Who's next?
That's correct. We expect another one to be listed this year, Banco Caixa. They already have announced it. And early next year, we're probably going to have the third one. So it's happening.
You were appointed central bank governor in 2017. Are you ready to go for another term?
Well, yes. I'm very happy with the work that we're doing here. We are satisfied with the results. But to be honest, we are focused on the job that we have on hand. So we'll see how things go. But so far, our concern today is keep on doing the job that we are doing the best we can possibly do.
All right, thank you so much for joining us. Jose de Lima Massano, Angola's central bank governor, joining us for an extensive conversation ahead of the elections. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Bloomberg has learned that Apple plans to begin manufacturing the iPhone 14 in India about 2 months after the product's initial release out of China. The company has been working with suppliers to ramp up manufacturing in India and shorten production lags. The tech giant is seeking alternatives to China as Xi Jinping's administration clashes with the US government and imposes lockdowns across the country. Now, Elon Musk has subpoenaed his longtime friend, former Twitter CEO Jack Dorsey, in his legal battle with the social media giant. Musk is seeking to collect documents and data to show that Twitter understated how much of its customer base is made up of spam and robot accounts. Dozens of people have now been subpoenaed by both sides ahead of that expected trial in October. Ford is cutting 3,000 jobs this week to fund its shift towards electric vehicles. The cuts will come primarily in the US, with some positions also eliminated in both Canada and India. The CEO, Jim Farley, has repeatedly said the company has too many workers. Ford wants to spend $50 billion to build 2 million electric vehicles a year by 2026. And Zoom shares fell in US late trade after it projected sales and profit for the current quarter below estimates. It sees annual sales growing to about $4.4 billion, down from its projection in May of as much as $4.55 billion. Zoom's pandemic boom has cooled considerably as offices reopen and competition intensifies from Microsoft Teams. And that's your Bloomberg Business Flash. Francine.
Thanks so much, Leanne. Now, coming up, Chinese banks are said to be employing unusual practices to inflate their loan volumes. We look at what's driving that next. This is Bloomberg.
started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now in China, some banks are inflating loan numbers as they struggle to meet government demands to pump more credit into the economy. Let's bring in our chief Asia economics correspondent, Enda Kern in Hong Kong. So Enda, good morning to you. Exactly what is driving this?
So the backstory here, Francine, is that in China's economy right now, there's no shortage of credit, no shortage of cheap loans, and the government is encouraging the banks to get money out there into the real economy. Now, the problem is, as the economy slows down, the appetite for borrowing among households and businesses just isn't there. So what our colleagues have picked up is that in the case of some banks, at least, what's going on is that they're lending out some money to some companies and then taking that money back in at the same rate in the form of a deposit. So it's kind of a money go around and speaks to the idea that these banks who are being told to lend that money just can't find those customers who are willing to borrow it because the appetite to spend and invest isn't there, against the backdrop, of course, of the big real estate slowdown and the ongoing restrictions from COVID-0. So it does speak to just how problematic China is finding it to get policy traction in the economy and to ensure that activity gets some momentum as we go deeper into the second half of this year.
So, I mean, this is not without risks. What are the main ones, Enda?
Well, I think the problem continues to be, Francine, at what point does the economy actually hit a bottom in China? The narrative had meant to be that July and August were supposed to see a turnaround, putting things on a better even keel heading into the back end of the year and heading into the Party Congress, but that's not happening. We saw a lot of fairly soft data last week for the month of July. But then, of course, we had the central bank cutting interest rates for the first time since January. Banks bringing down mortgage lending rates, but all of these steps speak to urgency among policymakers, but they don't speak to a turnaround in China's economy. I think that's what the big concern is right now, Francine, that there is this liquidity trap, that the issue isn't about the availability of credit, the issue is about why people aren't borrowing, and that's why there's a call for, or there's a sense that there will need to be a deeper and bigger policy pivot, maybe on the real estate side, or maybe on the COVID-0 side, to really jumpstart and rev up activity amongst households and businesses in China in the months ahead.
But is this, I mean, could this just be caution and planning ahead, and so people are being very careful? Or could it actually suggest a credit crunch?
Well, look, there's always a sense of caution in a slowing economy, Francine. You are right. China has a very high household savings rate, for example, so it's not like there's a liquidity or credit crunch or anything like that in China. But at the same time, the problem is that policy is struggling to get traction. And every time the government unveils a new measure, it's kind of met with either another reversal on the COVID-0 side of things. We've seen ongoing recent lockdowns and restrictions, of course, on Hainan Island, which snuffs out kind of consumer confidence. And of course, on the real estate side, despite the steps that they have taken in terms of bringing down interest rates and getting money into the system, we continue to see a downward spiral in activity there. So the point is that none of the levers the government have pulled so far have been enough to turn things around, and that's what's worrying economists. We saw those downgrades from Goldman Sachs and Nomura last week to maybe sub 3% growth now for the year. That's a fairly shocking rate considering what people were looking for at the start of the year. So I think the expectation is now that we will have to see a fairly aggressive step up in policy over the coming months if we are to see stabilization of growth. That is expected ahead of the party congress later this year. But the point is we haven't seen it so far. The economy hasn't stabilized, and that's what's concerning a lot of observers watching this.
And thank you so much, as always, for the wisdom and insight. Our chief Asia economics correspondent in the current. Now, coming up, Elon Musk subpoenas Jack Dorsey. We'll bring you the latest on the Twitter takeover battle. That's coming up next, and this is Bloomberg.
If you do any kind of business in this country, there's a pretty good chance that you're going to see that business registered in Delaware. Why? Because that's where you do it. And our point was Wyoming can be that venue for blockchain enterprise, for crypto.
It's not the Wyoming way to sit around and wait for change. We want that independence, we want that freedom, we want that individuality. And that's a common theme that brings together bipartisan support for this in Wyoming.
We want to make sure that people understand, especially in Wyoming, but as the United States as a whole, this trend is coming. It's not going to stop. This is more of a small town that's growing into what I would call the cryptocurrency version of Silicon Valley.
It's the philosophy of that rugged individualism, the independence, and the ability to really get things done for yourself and control your own destiny. You get that from a blockchain, and you don't get that without it.
No one covers the world like Bloomberg.
There's a sense it'll get to 7% in the coming months. Do you see that coming true?
There was something of a grey zone battle between Taiwan and China.
Where are the job cuts to come from? We will not just cut and run.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance, early edition of Francine Lacqua here in London. Now, Elon Musk has subpoenaed Jack Dorsey and his defense against Twitter's lawsuit to make him complete his proposed $44 billion buyout. Now, the Twitter co-founder has long been a friend of the world's richest man. Well, Dorsey stepped down as Twitter chief executive last year and has since been an energetic booster of Musk's bid for the company. Now, he tweeted in April that Musk was a singular solution I trust to take over. Now, for more, we're joined by Bloomberg Quick Takes Alex Webb. So, Alex, first of all, are you still friends if you get subpoenaed by the other one?
I mean, it's hard to see how.
And don't subpoena me.
But I mean, presumably, you can be subpoenaed supportively. I don't know. But I guess the thing is that Dorsey, it seemed pretty clear, wanted or wants Elon to
Musk,
acquire
yeah.
Twitter. Elon doesn't want to acquire Twitter, so there's already some tension in the middle of that.
Yeah, but do we know that he still wanted to acquire it once Elon pulled out? Like, what role has he played?
We don't know. Like, unfortunately, the irony is that Elon shares far more on Twitter than does Jack Dorsey, and Jack Dorsey was one of the co-founders. So, no, we don't know Jack Dorsey's thinking. I'm intrigued to see what becomes public from this subpoena, from this session, because there'll be some fascinating conversations under oath.
So do we have any insight into what Elon Musk is trying to find out with the subpoena?
Well, so Elon's whole case is built around this idea that Twitter overstated the number of accounts, or I should say understated the number of accounts that were bots. And presumably then he's trying to get data or admissions from Jack Dorsey that they knew that it was more than that. But I think ultimately the key thing here is Twitter, when it declares how many accounts it has and what percentage of those accounts are bots, it doesn't say the number of accounts total. It says the monetizable daily active users. So by definition, a bot is not monetizable. So therefore, it's probably excluding a bunch of bots already from that calculation, and then perhaps it thinks it might have not managed to suss out 5% of those.
But is the bots issue even really that relevant about why he's not buying it?
Well, not necessarily, no, because if you look at Matt Levine, our columnist in New York, has made this case very compellingly that Twitter, in their filings, they say, we think there's this number of bots. We might be wrong. If there's a better way of calculating it, we'd be delighted to hear it. Therefore, it isn't necessarily something that should be enough to stymie the deal or spike the deal. If they had misstated their accounts, for instance, they misstated their earnings, clearly that is something that is meaningful. Yeah. But, you know, daily active users and monetizable daily active users are not part of generally accepted accounting principles. It's something that Twitter it's a metric they've invented on their own, and therefore how they can be wrong is hard to tell.
Yeah, what a story. I mean, producer Assad really has the money quote, friends don't drag friends into court, unless you're very bored.
I mean, the life of billionaires is very different, perhaps.
That's it. The life of billionaires is very different. Alex Webb there with the very latest on Elon Musk. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller and Katie Lyons in New York. Anna Edwards is here in London. They'll have a full roundup of what to expect in Jackson Hole, that Jay Powell speech on Friday. Then we look at euro dollar. I know there's quite a lot of talk, of course, about equities, but if you look at where the big whipsawing is, it's definitely in cable. So we'll have, well, cable and euro dollar. We'll look at that. We'll also look at yen. This is Bloomberg.
When the price of anything goes up, the consequences reach far beyond what you'd expect. But perhaps most of all, when it comes to food. In 2010, surging food prices helped spark the Arab Spring. Lives were lost, regimes fell, and the consequences are still with us. Once again, food prices are rising, and fast. Energy costs, broken supply chains, and surging demand were just some of the factors that have driven food prices to their first record high since the Arab Spring. And that's all before a war between two of the world's biggest food producers. Ukraine is called the breadbasket of Europe, and taken with Russia, the two account for about a quarter of global wheat trade. They produce more than half of the world's sunflower seeds and oil, nearly 20% of the barley. Now throw in rising energy prices, and processing, transporting, even refrigerating food gets more expensive. Plus, fertilizer production is extremely energy intensive. Less fertilizer means lower crop yield, and prices rise even more. The pandemic revealed how complicated and fragile global trade systems are. Global agriculture, perhaps even more so. Unlike metals, for example, food goes bad. And crops take months to grow and are vulnerable to unpredictabilities like the weather. Rising food prices will be felt everywhere, but the poorest countries in the world will be hit the hardest. And as all these factors compound, the real fear is that record high will lead to record high, and ultimately to a global food crisis with vast consequence.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
What is your base case for Italy in terms of what happens politically and then what the economic fallout is?
Right now, central banks everywhere will take anything they can get.
It's almost like a sort of a hawkish sandwich around this mirage of disinflation that we see starting to dominate the narrative.
The Fed, and Powell in particular, needs to get across the message that the job is not yet done.
We're really playing a game where the market desperately wants the Fed to react.
Markets are not perfect, they're not always rational, and they just sometimes need to be given the alarm bells.
This is Bloomberg Surveillance, Early Edition with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. The Federal Reserve overshadows the markets. European stocks and U.S. equities waver over worries about more monetary tightening. The big squeeze. Euro area economic activity falls for a second month in a row. Record inflation is sapping demand. And Donald Trump reportedly has more than 300 classified documents at his Florida estate. Some of those documents are said to have come from the CIA and the National Security Agency. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta and Kaylee Lines in New York. Matt Miller is off today. Plenty of stories to dissect then, Kaylee. Plenty to get the details on with our team shortly. But in terms of where the markets trade, European markets and US futures suggesting a little bit more optimism after the devastation of yesterday. Asia, though, that was a different story.
It was indeed. And of course, the day in the US and Europe is still young. So a lot could change over the coming hours. But in Asia, as you alluded to, it was decisively risk off. We had stocks lower across Japan, China, Hong Kong, altogether taking the MSCI Asia Pacific Index down for a fourth day in a row, lower by about 0.9% at its lowest level in a little over a month. And even Chinese developers, those property stocks, which have gotten what should be some supportive news in the last couple of days around more loans to this sector, really trying to prop it up, also couldn't get a bid. Those were down about 0.7% when it comes to our Bloomberg Intelligence Index of those stocks. At the same time, as you were saying, Anna, of course, we are paying attention to the central bank story, the hawkishness of them, and that has seen a lot of movement at the short end of curves across the world, including in Australia, where the two-year yield rose about 7.5 basis points to its highest level in about 2 months. Finally, in foreign exchange, I would note you are seeing some outperformance from the Japanese yen today, stronger against the dollar by nearly 0.2%. Yes, at 137.26, that is still very weak relative to history, Kriti, but nonetheless, it shows that there's a little bit of a bid for that haven asset out there.
Well, speaking of a bid, I think you're really seeing that in the S&P 500 futures as well, but not with that much conviction. Take a look at this. The S&P futures up only 0.2%. I mean, it's pretty natural to see a little bit of green on the screen after the massive sell-off that we saw yesterday and, of course, Friday as well, and really led by those big cap names. So to see that reversal, once again, comes to no surprise, at least when you're looking at it from a technical level. But once again, no real conviction, at least when it comes to the early trade here when looking at futures. And I would say no real conviction in the bond market either. You're looking at a 10-year yield at about 3% with no real change in the move, and also no real change in the dollar, even though it is hovering around record highs, Anna. And this is going to be really significant as we talk about the ripple effects that you start to see across assets. At the end of the day, though, Bitcoin as that risk sentiment indicator, well, it's shining bright, bright green, up 1.7% this morning, Anna.
A pretty mixed picture, Chrissy, here for European stocks. European equity markets kind of divided, whether you look at the sector breakdown, where we're kind of evenly divided between the gainers and the losers, or the geography here, the DAX, the FTSE MIB in Italy doing okay. A bit more negativity coming through in Spain and in the UK. You'll see that the Copenhagen market in Denmark is particularly weak. More on that in just a moment. The UK market then down by 0.5%. Yes, higher energy prices is giving a boost to some of the energy names in London, but then we've got some negativity surrounding some of the other heavyweights in London, such as the drug sector, which is weighing. This is the Brent crude picture, and this is lifting some of the oil companies here in Europe, up by 1.2%. The Saudis then saying that they might have to come forward, or OPEC Plus might have to consider cutting production. So is the disconnect they describe between fundamentals and what oil prices are doing, which is interesting in the context of all the calls we've had from Western leaders to increase oil production in months gone by. This is the euro down below 1 once again, so below parity, 0.9932, actually off earlier lows, which is surprising given the negativity we saw in the data. A second month of contraction, at least in the PMIs, for the Eurozone economy. It's not just Germany now, it's France also with a number for the composite, which is below 50, which indicates contraction. But we saw the euro actually bounce off earlier losses as a result of the German manufacturing number not being quite as bad as anticipated. What was worse than anticipated was the UK manufacturing number, 46. We'll get more analysis from our colleague Lizzie Burden on this in just a moment, but 46 against an estimate which was much higher than that. So we might expect to see some weakness in the pound, not so, fairly resilient, 117.69 after a lot of recent weakness, of course. And this is the reason we see the Danish market under pressure. Müller-Maersk is down by 3.5%. The heavyweight logistics shipping business, we've seen Citi actually move this stock and the rest of the sector to a sell. They see an end to the exceptional shipping rates that we've seen in recent months, Kaylee.
Yeah, and of course, shipping and the supply chain is in focus as we see those strikes at Felixstowe in the UK, Anna. So we'll continue to watch that story, as well as a number of other stories in the day ahead, including retail earnings, which will continue with Macy's reporting second quarter results before the market opens. We'll also be paying attention to energy. German Chancellor Olaf Scholz is in Canada to discuss closer energy cooperation with Prime Minister Justin Trudeau. They will hold a news conference at 6:30 p.m. New York time. Plus, we'll hear from Minneapolis Fed President Neil Kashkari, who is speaking at a Q&A session at a gathering of the Wharton, Minnesota Alumni Club. And finally, in politics, Florida and New York will both be holding primaries ahead of the November midterm elections, Creedy.
Yeah, Kaylee, and of course, in the near term, though, what we're watching is going to be all about the Federal Reserve. Stocks down near the lowest levels of the month as investors brace for hawkish talk from the Fed at Jackson Hole. Joining us now is Ksenia Galushko, a Bloomberg Equities editor. Ksenia, thank you as always for joining us. What is the stock market reacting to exactly?
Well, it seems like the stock market is finally waking up to the risks of the hawkish Federal Reserve. So the rally that we've seen since July lows, which has taken the S&P 500 near a bull market, and the Nasdaq actually rallied more than 20% from lows. Now, this rally is at risk because of the Jerome Powell's upcoming speech at Jackson Hole, where he's supposed to reiterate the hawkishness of the Federal Reserve as it fights surging inflation.
Ksenia, another factor of the markets that we need to focus on is the dollar dominance, and we've certainly seen dollar strength as such a big theme. I read one of our pieces today on the Bloomberg terminal, which suggests that it is foolish to fight dollar dominance. That must be a sentiment shared by many.
Absolutely. Yes, the dollar hedge is really one of the most popular trades right now ahead of Jerome Powell's speech this coming Friday. I mean, it is a haven instrument, and it is one of the most popular ways of defending your portfolios at the moment. What's also not helping the sentiment is the fact that the euro is really weak at the moment, and that's happening because of the weaker economic data that we saw earlier this morning, and also because of the looming energy crisis, which is really weighing on the sentiment in European assets. So the fact that some of its biggest peers are under pressure, and the same goes for Asian currencies, is really helping the strength in the dollar.
Absolutely, and expectations for Fed policy have a huge hand in that. Bloomberg's Ksenia Galushko, thank you so much. And speaking of the Fed, later this week, surveillance will be heading to Wyoming, to Jackson Hole, for the Fed's annual symposium. Tom, John, and Lisa will be kicking off that special coverage on Thursday. Let's turn back to the economic data out of Europe now. The latest PMI data for August provides little comfort for the state of the European economy. French output is contracting for the first time in a year and a half, mirroring the trend seen in Germany. Joining us now to discuss is Lizzie Burden, our EMEA economics and government correspondent. Lizzie, what exactly does this data show us?
Well, Kaylee, let me walk you through it because there is quite a lot. France has unexpectedly contracted. Germany has continued its contraction, but we saw that coming because of its reliance on Russian natural gas. And then across the Eurozone more broadly, you saw this contraction driven by manufacturing, but it's also in services like tourism because of the impact of inflation. So it heralds a difficult end to the year for the European economy. Our economists and economists surveyed by Bloomberg do see a recession on the horizon, and it's a headache for the ECB because, of course, it's continuing to hike interest rates despite this momentum coming out of the economy.
Yeah, a lot of people watching the energy story and asking just how weak the Eurozone economy gets then through the winter, Lizzie. A lot of people asking similar questions about the UK, and that manufacturing PMI number today certainly will give a lot of people something to think about.
Yeah, the UK is still in growth territory, but manufacturing took a real blow. Really, it's only a matter of time until the story catches up with the UK. You've already got consumer confidence here at the level consistent with recession. I should note, though, our economists are saying that a recession in the UK will be milder than previous ones because of healthy household balance sheets, because of the fiscal stimulus we're expecting from whoever comes into number 10. But still, while Liz Truss is saying that recession isn't inevitable in the UK, Bloomberg Economics says she can only cushion the blow. A recession is coming.
Bloomberg's Lizzie Burden, we thank you as always. Let's go from economics in the UK to politics right here in the United States. The U.S. government reportedly has recovered more than 300 classified documents from Donald Trump since he left office. According to the New York Times, that includes papers returned in January, a second set given to the Justice Department in June, and the documents seized by the FBI at Mar-a-Lago. Joe Matthew, Bloomberg Washington correspondent, joins us now from D.C. for more. Joe, walk us through what we know. What's the latest?
The numbers are really the news here, Creedy, as there's so much we still have yet to learn about what exactly the Department of Justice and FBI were looking for. But the scale of this operation is giving us a better sense of why they sought this search warrant to begin with and conducted the search the way they did. The New York Times reporting the National Archives indeed found more than 150 classified documents in that first batch of material that was seized from Florida in January, including, importantly here, documents from the CIA and the NSA. The sensitive nature of what they found and Donald Trump's failure to comply with repeated requests to hand over more documents is essentially why they referred the matter at the National Archives to the DOJ. We should add that reports are surfacing now as well that investigators want access to more of the surveillance videos at Mar-a-Lago to see exactly who was able to access the areas the documents were stored in and when and why. Meantime, Donald Trump has requested the appointment of a special master to review the documents that were seized. It is unclear, Grady, if that'll be approved.
Okay, really fascinating developments there, Joe. Let's pivot to the latest on the attempts to revive the Iran nuclear deal. How much closer are we?
It's a great question. We understand that some gaps remain, but the report is of progress here. We heard from the State Department yesterday. Spokesman Ned Price says that they're actually seeing some progress in terms of some of the deal breakers, if you will, that Iran has pulled back from. We should note that Iran delivered its response to a framework drawn up by the EU last week. We're waiting now on the United States, which says that it's still looking through Iran's reply here. One thing that we know has been taken out of this and encouraging the U.S. government is Iran dropped this demand that the U.S. remove the Iranian Revolutionary Guard from its list of terror groups. That's not going to be on the table here, so it looks like we could have some movement. It's just unclear exactly what the sticking points are. The State Department says it will not work a day longer than it needs to in preparing a very specific response to what we heard from Iran. The EU's foreign minister saying that Iran's reply was reasonable. So let's see what the administration here in Washington has to say next.
All right, well, we'll look forward to your coverage of it. Bloomberg's Joe Matthew in Washington, thank you so much. And of course, you can listen to Joe every weekday on his radio program, Sound On. That's at 5 p.m. Eastern Time on Bloomberg Radio. Now let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. And I have to begin with Zoom. company we are very, very familiar with due to the pandemic. But as we emerge from the pandemic and people go back into the office, companies maybe want to spend a little bit less on this kind of software due to the softening macroeconomic environment. You have Zoom cutting their revenue forecast and also missing expectations from analysts. It actually reported its slowest quarter of revenue growth ever as well. So all of that together taking the stock down about 10% in early hours. It's a bit of a better earnings story though for Palo Alto Networks. This is a big cybersecurity company. It beat on its quarterly report and it beat on its forecast. So clearly a lot of demand out there in the cybersecurity world. It is up about 8.5%. And finally, I also wanted to check on AMC, of course, one of the meme stocks that has seen a lot of air come out of it over the last several days. This is actually a stock down 58% over the last 4 sessions, a 42% decline coming yesterday alone as its preferred stock Ape began trading. But you're seeing a little bit of a rebound coming into the shares of it as well as some of the other meme trades out there this morning. Anna, right now AMC up about 4.4% before the bell.
Our colleague Matt Levine out with a fabulous piece on meme stocks and where they head. Coming up on the program, though, Kaylee, Tom Caddick joins us, head of investments at Ned Group Investments. We'll continue to count down to the Jackson Hole Symposium, of course, and Harvard's status as the richest school faces an oil-rich contender in the University of Texas. Our Big Take looks at how crude and natural gas, not fundraising or investing prowess, have positioned the school's endowment to dethrone Harvard. You can read more on that story at Bloomberg.com or by typing NI Big Take into the Bloomberg terminal. And it's Tuesday, so don't miss Bloomberg Crypto today with Kaylee and Chrissy, of course, at 1 p.m. New York time. The weekly show covers the people, transactions, and technology shaping the world of decentralized finance. This is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
As the world watches inflation rise, employment rebound, and fiscal policies react, all roads lead to Jackson Hole for the Kansas City Fed's 2022 Economic Policy Symposium. Bloomberg's all-star team is live as policymakers and financial insiders discuss the economic issues and solutions that keep the world's money moving. Coverage starts August 25th on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Kaylee Lyons in New York and Anna Edwards in London. Matt Miller is off today. We are simulcast on TV and radio. We've been seeing risk sentiment really take it on the chin across the board. The stock market, even treasuries, starting to see a little bit of a sell-off, and commodities, of course, taking it on the chin. But it all kind of points to one asset that is hovering at record highs. For our radio audience, we are looking at a chart here of the Bloomberg Dollar Index and the ICE US Dollar Index. And you can really see this massive acceleration going into 2022. It's almost going, I don't want to say vertical, but it seems to be in that direction. And now is back up to those July highs, which, by the way, were an all-time record. The question, though, is the margin of the move. How much of it do you start to see actually have ripple effects in the stock market, in the commodities market? And what does that do when your macro hedge for a lot of investors is actually outperforming some of your core investments? We're going to ask Lynn Thomason, the Bloomberg Markets editor. She joins us now from London. Lynn, thank you as always for joining us. Let me put that question to you. What do you do if your macro hedge, your dollar trade, actually outperforms your stock trade, your bond trade, your commodities trade?
I'm sure that's a situation a lot of people are finding themselves in right now. And I think, you know, the chart just really speaks to the fact that the dollar is the one big trade that's working in markets right now, and it's consistently been working. And I think, you know, it speaks to, you know, the state of the global economy, where the U.S. is relatively stronger, and you're seeing weakness around the rest of the world.
A euro weakness is also a trade that, if you've been betting on that, that's also been working, I suppose, the other side of the strong dollar, Lynn. How much further does that have to go then? Do people suggest? Are we done pricing this in, or does it just get weaker from here?
No, I think the surprising thing is a lot of people see it coming weaker from here. So you've got plenty of forecasts. I know Nomura, Morgan Stanley are all sort of expecting the weakness in the euro to continue. And in some ways, it makes a lot of sense with the gas crisis continuing to get worse day by day, and the winter is still ahead of us.
That is absolutely true, and it felt like winter may have come for the equity market over the last several days, Lynn. It seems that the pain is taking a breather today. Is it a breather in the selling, or have we actually seen just the end of the rally?
I mean, I think maybe one way to look at it is the nervousness before the Jackson Hole speech, and, you know, just the anticipation for what that's going to bring. I think a lot of people are now expecting a hawkish turn and more, you know, whatever it takes to get inflation under control. And I think in that environment, people are very hesitant to put on more risk.
Okay, yeah, we'll wait for Jackson Hole then. Lynn, thanks very much. Bloomberg's Lynn Thomason joining us there with the latest on the markets. And for more market analysis, check out MLIV Go. That's the function on the Bloomberg terminal to find the markets live blog. Plenty there on the stock sell-off that we've seen and dollar strength. This is Bloomberg.
No one covers the world like Bloomberg.
There's a sense it'll get to 7% in the coming months. Do you see that coming through?
There was something of a grey zone battle between Taiwan and China.
Where are the job cuts to come from? We will not just cut and run.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
If you do any kind of business in this country, there's a pretty good chance that you're going to see that business registered in Delaware. Why? Because that's where you do it. And our point was Wyoming can be that venue for blockchain enterprise, for crypto.
It's not the Wyoming way to sit around and wait for change. We want that independence, we want that freedom, we want that individuality. And that's a common theme that brings together bipartisan support for this in Wyoming.
We want to make sure that people understand, especially in Wyoming, but as the United States as a whole, this trend is coming. It's not going to stop. This is more of a small town that's growing into what I would call the cryptocurrency version of Silicon Valley.
It's the philosophy of that rugged individualism, the independence, and the ability to really get things done for yourself and control your own destiny. You get that from a blockchain, and you don't get that without it.
From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg. The top names at the Fed are on Bloomberg.
I have a baseline case going into September that is 50 basis points. That's where I've been since the last meeting. But I have an open mind about whether 75 is going to be necessary. 50, 75 doesn't just depend on a data point, even an important one like the CPI. I like to say that we're data dependent, we're not data point dependent.
Nobody covers the Fed like Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Kruti Gupta in New York and Anna Edwards in London. Matt Miller is off today. Now keeping you up to date with news from around the world, here's the first word. Apple plans to begin making the iPhone 14 in India about 2 months after the product's initial release out of China. That narrows the gap between the two countries, but it doesn't close it completely, as some had anticipated. Apple has been trying to diversify its supply chain, but the company's high standards for secrecy complicated its efforts in India. Life expectancy in New York plummeted by 3 years in 2020. The CDC says that was the biggest decline among all states in the first year of the COVID pandemic. Residents of New York are expected to live to just under 78, the 15th highest life expectancy in the country. Overall, the U.S. life expectancy plunged by 1.8 years in 2020, the biggest drop since World War II. The U.S. warns that Russia is about to launch a new round of attacks against Ukrainian government facilities. Ukraine's preparing to celebrate its Independence Day on Wednesday. President Volodymyr Zelensky says that Russia, quote, may try to do something particularly nasty. And hedge funds are unleashing record bets the Federal Reserve will stick to its hawkish script at Jackson Hole. The group has collectively placed a big short across futures for a key overnight rate that moves in line with the Fed's benchmark. That position will benefit if Fed Chair Jerome Powell effectively rules out a dovish pivot when he speaks at this week's symposium. So clearly, Kruti, all of us are waiting for that speech from Chairman Powell around 10 a.m. Eastern time on Friday. And yet we are seeing really decisive moves and repositioning in the market in anticipation of it. People aren't just waiting for what he has to say.
And you know what I think is so fascinating here is that this is a hedge fund trade, by the way, that is the exact opposite of the way the market interpreted the last comments that you really saw. This dovish pivot that it seemed like the stock market was rallying off, but at the end of the day, it's actually this interesting turnaround that, Anna, this seems like people are saying, well, actually, not only are they going to be not dovish, they're going to be even more hawkish than expected given those looser financial conditions.
Yeah, I mean, the Jackson Hole Symposium developed a reputation over years gone by, didn't it, for being an opportunity for the Fed to reset market expectations. But if the Fed thinks the market has the right expectation, then maybe it doesn't create so much news. But there is a lot of expectation then, Kruti, to your point, that we will see something hawkish. So I guess one way that things could surprise is if we don't quite get the level of hawkishness we'd anticipated, where would that leave markets and their long dollar positioning? We'll put those questions to Tom Caddick, who joins us shortly, Head of Investments at Ned Group Investments. How does he position ahead of the Jackson Hole Symposium? What is he expecting Powell to deliver as his key message? We'll have more on that shortly. This is Bloomberg.
today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The Federal Reserve overshadows the markets. European stocks and US equities waver over worries about more monetary tightening. The big squeeze. Euro area economic activity falls for a second month in a row. Record inflation is sapping demand. And Donald Trump reportedly had more than 300 classified documents at his Florida estate. Some of those documents are said to have come from the CIA and the National Security Agency. I'm Anna Edwards in London, and Kriti Gupta and with Kriti Gupta, and Kaylee Lines over in New York. Of course, Matt Miller is off today. And Kriti, U.S. equity markets, U.S. futures, European equity markets, kind of moving around a little bit this morning, a bit volatile, but really waiting for developments later on this week.
A completely wait-and-see mode, Anna, and I would say that actually nothing has really changed in the last 30 minutes since we did our last market check. You are seeing futures higher to the tune about 0.1%. And once again, this is pretty natural, just given the massive sell-off that we saw yesterday and, of course, on Friday as well, to see a little bit of a green on the screen. But once again, not a ton of conviction when you look at futures trading. Like I said, up only 0.1%. And that's not just a stock story. You're seeing it in the bond market as well. 301 on the 10-year yield. Does it hover around that key 3% level ahead of Jackson Hole? And when do we actually see that perhaps psychological level not really be that relevant anymore? That's going to be the question I have for a lot of our guests coming up just shortly. We also have the Bloomberg Dollar Index, which really is taking, it seems like, the cue of the bond market. Still higher, hovering near those July highs, which, by the way, are record highs for the Bloomberg Dollar Index. But today, once again, no real conviction. That might explain why you're perhaps not seeing such major action in the stock market, and I would argue in the commodities market as well. Bitcoin, of course, up about 0.9%, still at that 21,000 handle, Kaylee.
Yeah, and we will be talking about that, you and I, later today on Bloomberg Crypto Kriti. So we will definitely watch those moves and watch how that is translating into crypto-related equities in pre-market trading as well. Because as you're seeing Bitcoin getting a little bit of a lift, these stocks are getting some much-needed relief. The likes of Coinbase up about 2%, and MicroStrategy, which is essentially a Bitcoin proxy because it holds so much of it on its balance sheet, is up about 5%. I also want to point out in other speculative areas of the market that you're seeing a little bit of life coming back into the meme stock trade. Bed Bath & Beyond is down more than 60% in just the last 3 days, but it's rallying by about 5.4% this morning. So no, it doesn't undo a lot of the losses we have seen in recent trading sessions, but nonetheless, a bit of a breather coming in. And finally, I just wanted to point out to Zoom, this is a fundamental story given it reported earnings after the bell, cutting its revenue forecast as businesses just aren't needing to get Zoom as much, considering a lot of people are back in the office. That pandemic era peak of Zoom, which we all got so used to, maybe is a fading story, and the stock is fading this morning as a result, down about 11% before the bell, Anna.
All those remote meetings, Kaylee, that we learned to know and love in some cases. Let's have a look at what we've got in these European markets then for you. We're down around 1/8% on the Stocks Europe 600, pretty evenly divided between those sectors that are gaining, those that are losing, geographies that are gaining, those that are losing. Not moving anywhere in a hurry, it seems, on these European markets today. We have seen weakness in data coming through as a big theme, and that applies to the euro and the pound. We're watching both of these in response to PMI data. The European PMI data told a negative story, contraction for the Eurozone economy, at least according to this data set, for the second month in a row. It's not just Germany, it's also France now in contraction. But we do see the euro actually off earlier lows. It has been weaker than this. It was threatening to go below 0.99 a little bit earlier on in the European morning. But the German manufacturing PMI wasn't quite as bad as expected. I'm clutching at straws, but that took the edge off the euro's fall. The pound, 117.65. It has fallen quite a bit recently, but now fairly steady at that 117.65 level, despite the fact we saw a 46 print for the manufacturing PMI out of the UK, a shortage of labour and an inability to get hold of some materials, apparently, the driver there. And Brent crude, also worth a mention, actually ticking upwards after recent contraction, of course, in the Brent price, 97.67, then up by 1.2%, as we hear, Kaylee, from the Saudis that they might have to actually cut back on production levels at the OPEC plus level because of the disconnect that they see between what's going on in the economy, concerns around growth dominating there, despite all of the calls we've seen from Western leaders to increase production.
Yeah, talking about that difference between the physical market and the futures market, and how it seems that futures are really underestimating the tightness of capacity constraints that are out there. So definitely a story to watch. We also, of course, are watching these equity markets, and joining us now to discuss them is Tom Caddick, Head of Investments at Ned Group Investments. Tom, we have seen some pretty substantial selling pressure over the last couple of sessions. Is the rally, a bear market rally, if it was one, over?
I'm not sure about over per se, but yes, clearly what we're seeing at the moment is oscillating markets that are playing very much along the theme of, how tight and how hawkish are central bankers going to be. And that's what we've been seeing. That's what we saw yesterday. Fortunately, from our perspective, we're investors, not traders, so we can look through some of this market noise, but it's very much playing off this narrative of concern around hawkishness of central banks.
Okay, but it isn't just noise. If we're seeing interest rate hikes for longer, or if we're seeing bigger interest rate hikes than had previously been anticipated, Tom. So with that in mind, what are you looking for at Jackson Hole? We always expect a lot. I wonder if this is going to be one of those years that materially delivers, or will we get a sort of holding statement from the Fed?
I think it's going to be a holding statement. I mean, it just doesn't make sense for Powell, for the Fed, to be making a very, very strong statement in terms of hawkishness, when realistically it's going to be driven largely by the inflation print that comes through. They've already made that indication. So I think for Jackson Hole, it's going to be a holding statement, or at least keeping options open ahead of the next inflationary numbers, which are going to drive very much the expectations around base rates.
Well, let's talk a little bit about capital flows here. We talked about the fundamentals with Jackson Hole. In terms of capital flows, I think it is a foregone conclusion for a lot of investors here that ultimately the pain that you're going to see in Europe is just going to get magnified come the winter season. But I'm curious what that means for the U.S. stock market. Doesn't that mean that if the rest of the world is struggling, the immediate investment is to buy American? So why isn't that happening?
I mean, I would broadly agree with you. And our positioning has changed over the last 6 months or so on the back of this. We've got particular concerns around Europe, where I think some of those challenges that you've just said, Kriti, are particularly acute and would favour the US market, which is greater breadth. Absolutely has inflation been a major issue, but we've started to see signs of that peaking, or at least some early signs of peaking. We've shifted our positioning to more of a quality stance over value or indeed growth, but particularly also focused more on the US, where we would expect to see outperformance.
Is the dollar the best hedge, Tom?
As opposed to Bitcoin? Absolutely. I do think, I think it probably is, but we've seen a lot of strength coming through from there. As a European investor, it's been a good place to be in terms of dollar. But yes, I think it probably is.
And real assets, Tom, you may mention in your notes ahead of our conversation about the importance of real assets and how they're actually quite a conviction play for you, including in commercial property. I mean, for the novice, you think about a rising interest rate environment, you're not sure what that does to property, or at least you know that it creates headwinds. What's the lure of these of real assets right now?
So we've got multiple attractions in here, and it is looking for where to put your money. And we've softened our position on equities significantly. We do have a preference for real assets or assets that have a strong and reliable compounding income generation capacity, plus some inflation protection, which is something that we've all been looking for some time now. But upward-only rental reviews. For us, you mentioned commercial property. If you're selective, being able to still buy into that reopening trade has been very successful for us, and I think that's got some way to go. Areas such as infrastructure or indeed renewable energy, where we can get some protection from that rising energy price, where you've got a direct linkage to electricity prices feeding through into valuations. So we've been looking very much for a degree of stability, a lack of cyclicality in some of those positions, as well as then that inflation protection coming through.
Tom, you mentioned that the dollar is still the macro hedge to go to. You also said that you were overweight U.S. stocks, but I'm curious, isn't that a contradictory trade?
No, I don't believe so. This is, we're talking relative in terms of our positioning there. So we've got the positions there. We partially hedge some of that, but broadly speaking, it depends what your base currency is. So we're coming in to get US exposure. We've also got some of that dollar hedge coming through actually in our FTSE 100 positions as well.
Tom, thanks very much. Thanks for your time. Tom Caddick of Ned Group Investments joining us there with thoughts on the markets. On a fairly quiet day in markets, but gearing up, of course, for Jackson Hole later on this week. It is August, after all. Coming up on the programme, though, a lot to talk about when it comes to labour market stress. We'll talk about UK strikes and the supply chain. Kate Jennings joins us, Logistics UK Policy Director. The focus of this week, of course, is Folkestone, the port of Folkestone on the east coast of England. What impact is that shutdown having on the economy? This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
At the start of the internet revolution, I kicked up a lot of controversy declaring that the internet had been underhyped. I say the same thing today about the climate revolution.
it is a kind of issue for the logistics industry and the freight industry and the shipping sector here in the UK. As Lizzie mentioned, Felixstowe is the UK's largest container port. But we do have other ports, so they'll help to pick up some of that slack. The issue is if you do reroute freight away from its traditional travel plans, etc., there will be a cost, and those costs will be passed on to importers, traders, and potentially ultimately consumers.
That was Richard Ballantyne, British Ports Association CEO, speaking to us yesterday about the strike at the port of Felixstowe. Around 2,000 dockers at the port on the east coast of England began an 8-day walkout on Sunday, halting the flow of goods through the UK's largest gateway for containerised imports and exports. Joining us now is Kate Jennings, Policy Director at Logistics UK. Kate, help us understand what kind of damage this does to the UK economy and the limits to that damage, actually, because of the types of things that we move around the world in containers and the other options that shippers then face.
Yeah, so first of all, I suppose the most important thing is that we hope the port will continue negotiations with the unions, because the best thing that could happen is that they reach agreement. But for a container port like Felixstowe, the majority of goods are not sort of just in time, they're not time sensitive. So what I expect has happened already is that the port will have brought forward some deliveries, they may have pushed back some deliveries, and they can reroute to other ports. So for example, in the UK, you have London Gateway, you have Southampton, you have Tilbury, all, relatively close in shipping terms to Felixstowe. So there is that capacity to move the goods by another route.
Okay, so there is at least that capacity to move things around. How normal would you say logistics in the UK are right now, Kate? And define normal however you like, given we're coming through the post-pandemic period, we've been through Brexit and the shock that created, at least for the labour market, and now we're dealing with strike action, at least at Felixstowe and also perhaps in Liverpool. How normal is the logistics sector?
I mean, I suppose this is like the new normal, isn't it? What I would say is the logistics sector has come through Brexit and COVID really well. Consumers haven't really missed anything. There were short-term demand shocks, at the beginning of coronavirus, but the shelves were quickly restocked. And I think we have a very dynamic, very effective logistics sector. That doesn't mean to say, I suppose for 8 days of strike, I think we can cope with that. I don't think people will see the difference. But obviously there will be costs. There will be costs to hauliers who might have been expecting to pick things up at the port and now will have to pick them up somewhere else. Or, so communication is key here. What we've been saying to the port is it's really important that they communicate with the hauliers, they communicate with customers so that we can minimise any impact as far as possible.
Well, Kate, you mentioned that a lot of these ships could just be rerouted to other ports. Is there capacity at the other ports to handle that extra traffic?
I mean, yes, absolutely. I would say there is for 8 days worth of strikes. It should be fine. Obviously it will be different if the strikes were prolonged. But I think we need to take these things step by step, don't we? And for the moment, I think we think this is manageable.
Kate, very quickly, what are we expecting here when it comes in terms of fiscal policy, for example? What can the government really do here to perhaps ease some of these issues?
Yeah, I mean, that's an important question. So as Logistics UK, we've asked the government to make a further reduction in fuel duty. You may remember there was a 5p fuel duty reduction in earlier this year, but that was quickly sort of swallowed up by inflation. And what you see happening is because inflation is going up, then the government's take on VAT is increasing. So our argument is that actually if they continue to reduce fuel duty rather than getting that VAT benefit, that will be better for cost of living, it will be better for business costs, it would help dampen inflation. So, we think a fuel duty cut would be helpful at this moment.
I wonder, Kate, if I could just ask you, in response to some data we got out this morning, what you see in the manufacturing sector, and clearly logistics operators will have a good sense of what's going on in that manufacturing space. We got a manufacturing PMI reading of just 46, which is contraction territory and really low versus what was expected. Away from that specific data point, I wonder what your experience at Logistics UK is telling you about the headwinds that the UK manufacturing sector faces right now.
Yes. I mean, I'm obviously aware that Brexit and COVID have had impacts on manufacturing. I can't say that at the moment that I know any more than you do, but it's one to watch, I think, isn't it? To sort of make sure those supply chains are supporting our manufacturing base.
Kate, obviously so much of the issues at play now come down to labor, and wages are a huge issue surrounding this strike in particular. But as far as labor ability in the logistics sector in the UK, are there enough people in the jobs?
That's a great question. So in Logistics UK, we're actually leading a campaign called Generation Logistics. Look out for it if you haven't heard of it. So what we're seeking to do is promote the logistics sector as a great place to work. I think a lot of people, are not aware of the range and diversity of opportunities available. And the fact that in particular, we did a report with Amazon recently, which highlighted that you can join the logistics sector with relatively low skills, but then there are opportunities to build your career and get into management positions. So it's a great sector to work in, and we're looking to promote that and attract people really to the sector.
Kate, thanks so much. Kate Jennings, Policy Director at Logistics UK, with her perspective on some of the disruptions that we're seeing to logistics in the UK right now. Later this week, Surveillance heads to Wyoming for the Fed's annual symposium at Jackson Hole. They'll be listening for the Fed and what the Fed has to say, what Jerome Powell specifically has to say about the state of the US economy, the level of hawkishness they intend. Tom, John and Lisa kick off special coverage on Thursday. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close. Weekdays on Bloomberg.
For Italy in terms of what happens politically and what the economic fallout is.
I don't think it needs to be part of the cure. What we've experienced, if we let inflation build up over time, like in the 70s, it was 7 years of higher inflation. If we nip it in the bud, which I still think we can, then you don't have to have these negative effects that people worried about.
John Taylor, professor of economics at Stanford University, of course, speaking with Bloomberg yesterday about how he doesn't see recession as needing to be part of the cure. Tom Keene, co-anchor of Bloomberg Surveillance, joins us now. And also during that conversation, Tom, we saw him reference the Taylor rule. I do like it when economics professionals come on and sort of name drop the rules they devised decades ago. That no doubt in focus for you. What else is in focus?
Well,
what data?
John Taylor is very gifted. He was one of the first people to support me in what I do every day, Anna Edwards, and that is a gentleman who in freshman economics at Stanford dresses up as a raisin. He walks in literally as a raisin to show agricultural economics in Northern California, something that...
You see, that's an image that sticks.
I could see Matt Miller doing that, actually, but that's a different... We'll say that for a different day. This is a really important chart and shows a difference between Powell and Lagarde. I went back 30 years. The word is never. We've never seen this. This is the fabulous Bloomberg Financial Conditions Index in white for America, in light blue for Europe, and they have never, ever diverged, Anna, like we see now. There they are in tandem through the pandemic, and the European Bloomberg Financial Conditions Index is back to where it was at the worst of the pandemic. The U.S. recovers nicely and is accommodative. The divide is extraordinary.
Tom, I'm sure it's something you're going to ask your guests on your show later today. Who do you have coming up?
Well, we've got lined up mostly about the markets. Jan Hatzius will join from Goldman Sachs. We'll get an economic briefing from him. Obviously, pre-Jackson Hole briefing. We're scheduling our exit tomorrow. We're not taking the Gulf Stream. Very important. We are climate sensitive. We're looking at our footprint. Lisa demanded that. But we've got some other people as well. We will address Ukraine, and we will address the suburbs of Moscow with Tina Fordham of Fordham Global Insight.
All right, looking forward to it, Tom Keene. Thank you so much. Bloomberg Surveillance coming up over the next 3 hours. But let's take a look what we're watching even beyond that. I will be watching the Fed's Neil Kashkari speaking tonight at 7 p.m. He, of course, is the Minneapolis Fed president. He's going to be speaking at a gathering of the Wharton, Minnesota Alumni Club. He has become firmly in the hawkish camp. He has said recently that he would like to see the Fed funds rate at 4.4% in 2023. So what kind of tone is he going to strike as we beat the drum toward Jerome Powell's speech at Jackson Hole on Friday? Is this a Fed that is going to be continually forceful in pushing back against market expectations that have turned more in the dovish direction, Creedy?
Yeah, and Kaylee, at the core of that argument is going to be a very tight labor market. But guess what else is extremely tight? The housing market, which brings some of the data that we're going to get about 10 a.m. Eastern New York time. Really crucial. We're getting some U.S. new home sales as well as the Richmond Fed Manufacturing Index also coming out, plus some of that PMI data. But really, it's those new home sales that I have my eye on, Anna.
Yeah, absolutely. So that'll be the data focus. In terms of the politics and how that weighs in on markets and economic expectations actually into the winter, I'll be focused on Chancellor Olaf Scholz, who's making a visit to Canada. It's going to be the second day of his visit. Here we see images of the first day. There's the press conference they gave on Monday. There'll be another press conference taking place today, as we said a little bit earlier on in the show. Can Canada help with Europe's gas issues? That's the big question going into this visit, I suppose. And maybe the answer is sadly not really in the short term, maybe more in the long term. There's been talk of regulatory barriers being overcome to increase exports of LNG from Canada. But remember, a lot of the production in Canada is in the West, and a lot of the export would need apparently to be in the East. And so there are challenges that remain in that regard. Today, their attention actually turns from gas to green hydrogen. So trying to reset the conversation a little bit, but still very much around energy. And it is those energy questions that are set to dominate the European economic debate as we head into the winter. That is it for the early edition. Surveillance is ahead. Tom, John, and Lisa will be with you to take you through some great conversations coming up here on Bloomberg TV. This is Bloomberg.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The Fed, and Powell in particular, needs to get across the message that the job is not yet done.
It's not just about what the ECB does and what the Fed does. You have to take into account the market's inflation premium.
We're really playing a game where the market desperately wants the Fed to react.
We are still very much in the early days of recovering off of an extreme low.
Right now, central banks everywhere will take anything they can get.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
This economic data is not pretty. From New York City, for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures positive 1/3% on the S&P. TK, that data out of Europe, ugly.
Well, the data out of Europe's ugly. It's ugly everywhere, John. It's going to be interesting to see the data as Chairman Powell waltzes to Jackson Hole. What I would suggest, John, is after the difficulties yesterday, down over 600 points, what we see this morning in foreign exchange, John, can you imagine his speech if we get Monday, Tuesday, Wednesday, Thursday of this kind of market action?
And then clearly it changes, Tom, because what we've seen over the last month or so is an easing of financial conditions. They've certainly tightened up over the last couple of days, and we're seeing real weakness abroad, not just in Europe, in China too. Well, here's the quote off the back of the European data. The data points to an economy in contraction during the third quarter. Tom, that's what we're all looking for in the European economy.
I would agree, and I like the idea that you devolve down to what is economic growth doing, because that to me is the end result of all this, and we'll address this. Jan Hatzius with us here from Goldman Sachs coming up. But John, to me, the number one thing right now is away from the strategists and all that. It's trying to get a handle on the interdependencies of these global economies. What does Governor Bailey say to Chairman Powell at Jackson Hole?
Governor Bailey staring down the barrel of a real slowdown. Bramo, did you see that data this morning? The manufacturing PMI in the UK, brutal.
Stagnation over there. In the euro, they're just sliding toward a recession. That's the view from Bloomberg Economics. The UK is already in stagnation, and the recession is inevitable. The question really is just how deep. Hiking into pain. And really, I got to reiterate what Tom was saying. The issue is how much can the U.S. continue to diverge? How far can it go as you do see all of this pain trickling out in European data?
Can it decouple? What do you make of the market move? 2 days, down 3.4% over the last 2 days on the S&P.
The bulls are getting more entrenched. The bears are getting more entrenched.
There
and that's,
we go.
I mean, honestly, that's my takeaway. You read the notes. The bears are saying this is clearly a bear market rally. The bulls are saying we've already seen the bottom. This is a time to pick up things on the margins, and you have not seen really a shift in the two camps.
The theme here is Chairman Powell. I mean, the shock of Chairman Powell pivoting or suggesting pivot light at Jackson Hole would be like the same as Man U beating Liverpool. It's unthinkable.
Unthinkable, but it happened, Tom. I think there's more chance that Manchester United win the next game that Chairman Powell's going to pivot later this week.
That could be.
He never really did pivot. Let's put it that way. I think at the end of the day, what people are looking for here, Lisa, they're looking for a shift lower from a 75 down to a 50 to a 25 and hopefully a pause. And then the market's looking at cuts next year. And that's the big difference between the market and this Federal Reserve. A market that's looking for cuts next year and a Federal Reserve that's talking about raise and hold.
Okay, but here's my favorite part about markets. Everyone's anticipating a hawkish message from Fed Chair Jay Powell, and they're lining up their bets in anticipation of a hawkish discussion on Friday at 10 a.m. At what point do we then get a buy the rumor, sell the news kind of activity when he actually comes out, even if he's hawkish? I mean, this just is the mind-spinning aspect of markets.
Daddy went away for summer, the kids were playing games, and then he's going to come back after a long summer and do a speech. So, Brahma, they're clearly cleaning things up.
The kids playing
games. You tidy the house, don't you?
Is that us for going on vacation?
Or it's market participants, like toddlers sometimes. Futures positive, 0.25% this morning on the S&P. On the NASDAQ 100, up 37, up 1/3%. We bounced back a little bit after 2 days of ugly losses. Yields higher by not even a basis point, through 3% in the last 24 hours on a 10-year, 3.0165%. And maybe, Lisa, we need to get used to this. Euro dollar breaking through parity.
You know, I find this fascinating because we did see that breakthrough parity actually closing below parity for the first time going back to 2002. It is solidly there. We have reached that level and we are not going back, and that seems to be the direction of travel. Okay, so talking about the European PMIs, we do get a series of S&P PMIs from the United States at 9:45 a.m. At 10 a.m., we get U.S. July new home sales. I'm actually more interested in the new home sales because in the United States, I'm less interested in the real-time deterioration in manufacturing and services than I am in how much the housing market is rolling over. How horrific is it or not? As we see the volumes really tick down. We have seen an incredible tick down in the volume of number of transactions. At what point does that translate into lower costs, lower confidence, the whole sentiment, a read through of lower prices of mainstays in investment portfolios? At 1 p.m., we get the U.S. selling $44 billion of two-year notes. This, to me, is actually a particularly interesting auction given the positioning. Hedge funds shorting the front end at the fastest pace on record, according to some measures, ahead of the expected hawkish speech on Friday from Fed Chair Jay Powell. And today, this is the tail end of earnings season. The vast majority of U.S. companies have reported. However, we get the latest read on the consumer. Macy's is reporting any minute now. Dick's Sporting Goods is at some point this morning, as well as Nordstrom after the bell. At what point do we get some sort of read, John, on the consumer versus idiosyncratic stories? If you take a look year to date, they have been incredibly divergent, these retailers, in terms of their fortunes. How much do you see an ongoing divergence versus a cohesive message about how much momentum consumers can really have at a time of such high inflation?
Elisa, thank you. Can I just say the chart of that 2 year is just ridiculous.
It's ridiculous,
Every time I see it. Every time I see it. Lisa, thank you. For much of the last 10 years, when you get this gloomy data and things start to look bad and the market sells off, I'd catch up with Steve Orth, the Federated, and Steve would turn around and say, just buy it, John, get a grip, it's not that bad, just buy it. And it turned out to be okay, and buying it was the right thing to do. Steve Orth is not saying that anymore. The Chief Investment Officer for Equities of Federated Hermes joins us right now. Steve, you're not saying that anymore. Walk me through it. Why you're so defensive this time around?
It's different this time, John. I mean, I was thinking about when you're talking about how there could be hiking into, a recession in the UK. Well, what's causing the recession is the inflation in the UK. And, the banks are really in a tough spot here where you've got a very high and I think stubborn inflation problem driven by, maybe a temporary commodity price hikes, et cetera. That's part of the problem. But underneath it all is shortages in housing, shortages in labor globally. And the pressure there on the core inflation numbers, we think, is going to be around for a while. So this idea that, we're going to get back to the kind of deflationary period before COVID that we experienced for 20, 30 years and was, a big driver of markets because of low bond yields. We just think that's probably behind us, and the markets need to adjust to a longer term, something north of 3% inflation environment, a 10-year yield in the 3 to 4% range, and valuations after this last rally are just, especially on the growth side of the equation, which which is where we cut again yesterday. Frankly, these stocks are just overpriced. And
Steve,
go ahead.
you've got 10% cash, which is absolutely extraordinary. I never thought I'd say that about Federated, that you're loaded up that much. That's a huge amount of cash, folks, to have in a long-only buy-side fund. How will corporations adapt to this higher inflation regime? How do you presume that your top 40 holdings will adapt and adjust out the next 3 to 5 years?
Well, Tom, one thing that we're overweight is dividend-paying stocks. And, those companies have pretty stable businesses. They've got pricing power. They can gradually increase pricing on their portfolio. They should have nominal sales that will go up with nominal GDP. And the stocks are not crazily priced, and they're throwing off dividends of 3 to 4%. So, getting a return in cash of 3 to 4%, we think is not bad with a little bit of appreciation. We've been telling our clients, the days of 15, 20% per year are behind us now. We got to be thinking about mid-single-digit returns on stocks in the next 3 years. I would point out that cash isn't as horrible as it used to be, Tom, when you were, doing your 3X leveraged money market fund. I mean,
Federated stole that idea. John, Federated stole that idea from me, just so you know.
I'm not sure how much money they owe you for that.
A couple of percent right now, and we think they'll be paying 3 soon. So, that's not a bad return relative to bonds, where we think you probably still have price risk on the bond side. So we're overweight cash, we're underweight bonds, we're overweight value stocks, and we're underweight growth stocks, where we think the valuation is going to compress. So it is defensive. It's probably not as ridiculously defensive as you'd think. If you look at, you're expecting a 5 to 7% return over the next 3 years, per year.
Steve, just to put this into cold relief, it sounds like you're incredibly bearish when you say we're now underweight equities for the first time in nearly a decade. What is the nature of the downturn, just quickly, in terms of what you're expecting versus just simply a reallocation based on the first time that we're getting real yield in a very long time?
Right, it's the rocky landing idea, Lisa. We don't really think we're in for some sort of crisis recession here, although, there's possibilities of that. But we're looking at a rocky landing. We think we're going to be bouncing around real GDP growth in, plus or minus 0, 1% for the next 6 quarters. We think inflation's going to stay pretty high, come off, the levels we are now, but still pretty high. And the Fed is not going to pivot, because the playbook they're following is the 1970s, where the Fed made the mistake of pivoting too soon, and that led to a resurgence of inflation that caused Volcker to have to tank the economy into a double-dip recession, as everybody knows, in the late 70s, early 80s. So I think that's the playbook they're playing. I am totally not expecting anything dovish out of Jackson Hole on Friday, and I think the rally's just gotten a little bit ahead of itself, frankly.
Hey, Steve, awesome to catch up. Steve Orth there at Federated Hermes, with a very, very different perspective relative to what we've heard from him, Tom, for the last decade or so.
Yeah, really, we want to emphasize to people, we talk to these guests time and time again, and that is a new Stephen Orth.
Brilliant lineup this morning. We'll catch up with Jan Hatzius at Goldman Sachs at 7 a.m. Eastern time, so we'll do that in about 50 minutes' time as we continue to count you down to Jackson Hole, Wyoming, and that annual Fed get-together, where we'll hear from Chairman Powell this Friday. Futures up 0.2%. That's a small bounce relative to the move downwards we've seen over the previous 2 days. It's a cloudy New York City this morning. Bramo, what did you do? Good morning to you.
Thank you.
This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Ritika Gupta. There are signs that fears of a recession in Europe may be coming to pass. Economic activity in the Eurozone fell for a second month. August's drop was driven by manufacturing. Still, the post-lockdown rebound in services like tourism almost ground to a halt. Consumers have been hit by big jumps in energy and food costs. And those gasoline prices in the U.S. have now fallen for 70 days in a row. That is the most in more than 7.5 years, according to the Auto Club AAA. Pump prices are averaging $3.89 a gallon after reaching a record high of around $5 in mid-June. And the US warns that Russia is about to launch a new round of attacks against Ukrainian government facilities. Ukraine's preparing to celebrate its Independence Day on Wednesday. President Volodymyr Zelensky says that Russia, quote, may try to do something particularly nasty. The US government reportedly has recovered more than 300 classified documents from Donald Trump since he left office, according to the New York Times. That includes papers returned in January, a second set given to the Justice Department in June, and the documents seized by the FBI at Mar-a-Lago. The Times says some of the documents came from the CIA and the National Security Agency. Shares of Zoom are lower today. Second quarter results showed that its transition from an essential COVID-era tool to an enterprise business platform will take longer than usual. Zoom reported the lowest sales gain in its history, plus its revenue projection fell short of estimates. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
What do Formula One cars and your local supermarket have in common? Well, strange as it sounds, they might both be using the same technology. A lot of innovation has trickled down from the world of high-tech engines, and it hasn't just found a new life in road cars. F1 cars have long been thought of as the peak of cool, and technology in them is also helping to cool down our produce aisles. Engineers from Williams are using their knowledge from 9 Constructors' Championships, working with company Aerofoil to help reduce the energy consumption of supermarkets. The device they're building is based on the design of an F1 car's rear wing. It attaches to fridges to keep more cool air in the unit. They estimate it can reduce supermarket energy consumption by 25%. One innovation from F1 is also helping hybrids reduce their carbon footprint. That's KERS, or the Kinetic Energy Recovery System. In common parlance, it's known as regenerative braking and works by storing energy of the car decelerating in a battery for later use. If that's not enough, F1 is now looking at TERS, or a thermal energy recovery system, looking to harness the heat produced from braking and the engine exhaust. That could allow cars to generate the same power using 30% less fuel. So while F1 may have a reputation as a gas guzzler, some of its innovations in the name of speed are helping in the everyday fight against climate change.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
The difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg. This week, as the world watches inflation rise, employment rebound, and fiscal policies react, all roads lead to Jackson Hole for the Kansas City Fed's 2022 Economic Policy Symposium. Bloomberg's all-star team is live as policymakers and financial insiders discuss the economic issues and solutions that keep the world's money moving. Coverage starts August 25th on Bloomberg Television and Radio.
Independent of this gas supply, and we are doing a lot of investments to make it happen, and we are doing it as fast as ever possible. Never such an infrastructure has been built in Germany in that a short time.
Chancellor Scholz has got a lot of problems. I imagine being in Canada is not one of them right now. He wants to get away, TK. Get away fast. Problems at home, building up in Germany and Europe. Lisa, it was just let's let it go. Right?
To Canada?
Yes.
He's going to escape to Canada?
Maybe just let it go. It's still early. Let me get through the market check. Then you can say whatever you want.
I'm not saying anything.
You can say whatever you want. I'm not going to police anything.
Here. No.
Say whatever you like.
I love those markets. Look
Futures up a little more than a tenth on the S&P. On the Nasdaq 100 up by 0.14%. Yields unchanged. Just north of 3%, 3.0183%. Lisa? Got things to say? You good?
I'm so good. This is great.
You're done.
Yeah,
TK, how are you?
It's a domestic. it's a domestic.
When are we getting in the same room? What are we still doing out here?
I don't know. Are we on the same? I don't think we're on the same plane. I was going to take the Gulfstream, and they wouldn't let me because of the carbon footprint.
We're on different planes.
We're on. I think all of us have to fly on different planes.
No, actually, what's actually happening on Wednesday is I'm on the first flight with you, and I'm on the second flight with Lisa.
Just
to make sure you all gradually get there and you don't get too jealous about one person being with the other for too long. I've split up the trip.
I'm going to ride an elk there.
I'm threatening to read Elizabeth Economy on China on the plane.
On the way to Jackson Hole?
Yeah.
Okay.
That's sort of what
I'm pleased to know that you'll be dialed in on Fed policy.
What we can do is we can waltz from the west to the east on 96th Street in Central Park. We can do that past the tennis courts, past the lake, wave to vet bill and kennel fee as you walk by. There's been a lot of walking done in the Democratic Party, and today there is an election in New York. Granted, it's about New York. It's not about the rest of the nation. But nevertheless, Joe Matthew knows the distance across Central Park says much about the Democratic Party. Joe, it's Nadler and Maloney. They've been doing this forever. Everybody's focused on this race. What does it symbolize to Mr. Schumer and the future of the Democratic Party?
Well, for Schumer, it looks like a win. He endorsed Jerry Nadler, which has gone a long way to help his standing here when you look at the numbers. But this is why politics can be a very dirty business.
Yeah.
These two were allies. They were elected together in 1992. They were part of the senior leadership in the Democratic-led House. This would be like, Tom, like if you were competing against John Farrow on some other network, looking back on the days in which you co-hosted Surveillance, and things get ugly when you start to compete. I mean, you know,
Joe, you're describing Friday. Okay. Joe, what is
that? May be true.
Okay, what's the difference between Nadler and Maloney?
Well, a man and a woman, if you ask her.
Really?
If you saw, look, you see in the ad, you can't send a man to do a woman's job. And she has reminded people of her work as a pioneer, the first woman to chair the powerful oversight committee, and has really kind of gotten her arms around reproductive rights as an issue for New Yorkers here. Jerry Nadler, though, will say, hey, listen, fine, if you get rid of me here, you're not going to have a Jewish member of the delegation in an incredibly important part of the country here. New York Times endorsed him. Chuck Schumer endorsed him. I think we see where this is going to go here. But to see two powerful incumbents like this who have been allies for so long, for 30 years, is quite remarkable.
Why? Why is this happening, Joe?
It's all about redistricting. Look, you know, when the maps change, sometimes powerful neighbors can find themselves in the same district vying for in some cases, similar patches of voters here. This is going to look a little bit different for both candidates, though, once the new district is in place.
Joey, I ask this because I know down in Florida, Ron DeSantis is running uncontested in the Republican primary there, and the contest is really among Democrats. How much is this a theme? With Democrats having contested primaries and Republican incumbents having much more power heading into this November 8th election?
It's been a bit of a theme. We've talked about this, of course, repeatedly over the course of the primary campaign. Democrats have tried to prevent that from happening in a lot of cases, and in some cases, it's inevitable when you redraw a map. There's not a lot that can be done about it.
So, Joe, one of the big themes has been the Democrats aren't losing as much as people thought. You have even Mitch McConnell coming out and saying that there's a likelihood that the Democrats will keep the Senate, even if they have to give up the House to Republicans. How based in truth is this, based on the polls, based on the activity in some of these primaries?
It's hard to tell when you start talking about polls, because national polls in the midterms are very difficult to tie to reality. When you start particularly looking at generic ballot polls, they play well for Democrats right now, but of course that doesn't jive with President Biden's approval ratings, and it doesn't really add up to what we're talking about here every day with regards to inflation and so many of the other issues that have been dogging Democrats here. So it's hard to say, but when you hear Mitch McConnell speaking to it to the extent that he did and referring to candidate quality, he's talking about the Herschel Walkers, the J.D. Vances, the Dr. Oz's, who he doesn't feel a great amount of confidence in. They're Donald Trump endorsed products and not the candidates that Mitch McConnell would have chosen. That doesn't mean, though, Tom, that we don't wake up surprised on that next Wednesday morning when they've all been elected. it's too difficult to tell.
Joe, on Wall Street, there's a kickoff to after Labor Day. September is the beginning anew. Should we be surprised to see Biden administration changes in September?
September might be a little early. That might really follow the midterms. November isn't too much later, obviously. But yeah, just to keep from muddying the waters here and getting in the way of the narrative. I think what the president is planning, though, is a national tour. Whether they put him on a train or send him on Air Force One, you're going to be seeing him in a lot of cases, Amtrak Joe, trying to make the case for infrastructure and things that no one's talking about here. All the while, foreign policy surrounding this president as he spends a little more time in Delaware here. It's a very quiet period in Washington, but they are busy talking about these plans that they're making for fall.
Do these candidates, Joe, want Amtrak Joe to stay in Delaware?
That's the question, and it depends who you ask. For some, look, being on stage with the commander-in-chief is a big deal, but you are going to see kind of a case-by-case situation. It depends on how well Biden played in that given district that you're talking about in 20 and exactly what the economic straits are in that area. If we're talking about inflation as opposed to infrastructure, I won't say build back better, some of the other legislative accomplishments that the president has made, yes, he'll be welcome. John Fetterman in Pennsylvania, for instance, says he welcomes the president on stage anytime. So you're going to see different versions of that across the country, and that's not a Joe Biden phenomenon. Realizing his approval ratings are deep in trouble here. That happens in midterms, where commanders-in-chief, based on the historical trends, really don't always help people who are running for Congress.
Joe Matthew, great to catch up. Don't miss Sound On. On Bloomberg Radio, weekdays, 5 p.m. Eastern Time. TK, what are we looking at now? Democrats keep the Senate, they lose the House?
Yeah, that's sort of the new zeitgeist. It's very fluid right now, and it helps to have someone like Joe Matthew who's just steeped in this stuff. I could never do what he does, John. I don't have the brain for it. All the back and forth.
We'll catch up with Mark Howard of BNP Paribas on this market in just a moment. Futures unchanged on the S&P. From New York, this is Bloomberg.
I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
No one covers the world like Bloomberg.
Does the Fed will get to 7% in the coming months? Do you see that coming true?
There was something of a grey zone battle between Taiwan and China.
Where are the job cuts to come from? We will not just cut and run.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This equity market bounce this morning is struggling to hold. We fade. Futures now unchanged on the S&P 500. On the Nasdaq, very slightly negative. On the S&P over the last 2 days, the biggest two-day drop since the middle of June, down about 3.4% on the S&P 500. That's the equity picture. Here's the bond market story. The first day of August at the close, your two-year was at 287. Look at it now, 333. Yields up again by a couple of basis points. The highs of the year intraday on a two-year, 345 TK. So not a million miles away. And the direction of travel over the last few weeks, you've seen it. Yields higher at the front end.
John, this is really, really important. Any good moving average, and you don't want to hang on moving averages, but the moving average that I use of the two-year yield is demonstrably higher yield than it was in June. It's the sustained nature of the two-year move now that's important.
So what we've seen now, Tom, is the two-year yield start to break out, back to those June highs again. Not quite there yet, but it's happening.
But the moving average is above.
And as that happens, Tom, the dollar's strength starts to boil. And we've seen that in the last couple of days, haven't we? Let's take a picture of euro, dollar, and sterling. That's for Bramo, just sort of emphatic language about bad things happening. Euro, dollar, a break of parity in the last 24 hours. Cable, a break of 118 and 117.54. For the UK and the Eurozone, Lisa, the data, terrible. Manufacturing, both in the UK and Europe, in the 40s. And for people familiar with the data, you all know the difference between 50 plus and below is expansion and contraction, and that is solidly in contraction.
And we were kind of expecting that kind of weakness from Europe, but the confirmation of it in the biggest economies in Germany and France has really gotten a lot of people concerned. And I will just say I should change my Twitter profile to speaking emphatically about bad things that could happen to us.
It's a toxic brew, Bramo.
Toxic brew.
All right.
More euro weakness, TK. On the screen this morning.
Yeah, very importantly, sterling down to 117.18, I believe. We didn't see a 116, virtually unthinkable a number of weeks ago. Mark Howard is seeing the unthinkable, holding court at Barclays, and now senior multi-asset specialist at BNP Paribas with a very important research note always on fixed income right now. Mark, you go to where I am. You and I are in the same camp. It's not about single picking the moment as the media does. You look for a message of a sustained strategy by the Fed. What will be sustained about Chairman Powell's speech on Friday?
I think what's going to be sustained, Tom, good morning. Thank you for having me. I think what's going to be sustained is the focus on trying to squeeze out inflation to the extent the Fed can. You know, they had to scramble to get caught up, which caused the markets to, to overcorrect on the downside through mid-June. And then we had a little bit of good news, a little bit of dovishness, and now I think he's going to set the record straight and say, don't expect a dovish pivot anytime soon. And that's why we've seen the front end, your WIRP measure, adjust over the last several days. There's not going to be easing anytime soon in our view.
Non-pro question. You are a dyed-in-the-wool optimist. Do you share the gloom that's floating around right now?
Well, I don't know that it's gloom, Tom. Your earlier guest, Mr. Auth, I think had the right tone, which is that inflation is a real challenge, not just in the U.S., where we've seen it, settle a little bit, but you guys mentioned yesterday what's happening in the U.K. And in many of the emerging markets. There's a real challenge, and central banks globally are going to be squeezing against that, and that's going to weigh on growth, and ultimately, with the lagged effect, that's going to kick into corporate profitability. And I think it's prudent to not expect the market to continue to rebound. I think we're going to settle in here. Our target for the S&P, for example, is 4,400 by the end of the year. So we think it's appropriate for the market to have leveled off recently.
Mark, you and your colleague Sam Linton-Brown had the courage to buy some of that weakness in the middle of June, and you and I have talked offline about that. You've always got to think about the story. Okay, might not sound good. Then think about the price of the story. Can you talk to me about the price of the story in Europe now? We're all familiar with the story. It's not great, is it? Talk to me about the price of the story. How well priced are we for that pretty terrible picture we're expecting at the back end of this year?
Yeah, thank you for the kind words. You're right. Sam and team definitely had a courageous call, and rightfully, I think, have recently started to moderate that call to be a little more balanced in the outlook. So, the European outlook, as you've rightly highlighted, is quite challenging, not just on the continent, but also in the UK. And with what's happening recently, just the last several days around power and energy prices, there's genuine reason to be concerned of real stagflationary pressures as the year plays out. We do believe the central bank in both ECB and the UK will hike in September, and that's a very challenging near-term mix for risk assets. But ultimately, we don't see a major correction in European asset prices, but we do see a choppy road ahead.
Mark, you talk about hiking into weakness, and this has been a theme throughout 2022. What's the trigger point for central bankers to stop hiking? And this has been what people have been really debating as to the pivot that some people said never happened, and how Jay Powell might reiterate a hawkish message on Friday.
Well, I think there are several different things. It's not a linear line that you get to this point and then they stop hiking. Clearly the global economy is going through a downshift. You guys haven't talked much this morning about China, but you did yesterday, and that's another variable that I think is important. So growth, I think globally is going to moderate a good deal next year, and I think that's going to create a window of opportunity after the Fed has hiked further in September, November, and December, probably by 25 basis points, those last two this year, to take a pause and let the contractionary impulse of that monetary policy and QT play through to the real economy. And that's when they're going to reassess. That's when we're going to see a pause in the hiking cycle. They may have to hike further if inflation doesn't moderate as they expect.
Yeah.
But I think with the negative impulse of global growth, China and Europe in particular, weighing on U.S. growth and export activity, as well as the strong dollar that you referenced, all of that should create an opportunity for the Fed to take a pause early next year.
Mark, since we haven't mentioned China, it's a perfect opportunity for us to do so. Where has the market not priced in the slowdown that we're seeing actually confirmed even by official data coming out of China?
Where have we seen that priced in? Well,
where have we not seen that priced in to the extent that you think we should?
It's we've certainly seen it in the currency. I think it is fairly priced in. We've seen obviously real stress in credit in China. We've seen equities which had a rally earlier this year have come off, and the currency is moderated. So I think it's reasonably priced in. Chinese markets are very, very tricky, as you know, much more so than the Western ones, just because you don't have clarity. It's not just a fundamentally driven market. You've got incredible monetary and governmental stimuli and contraction that can go on. I think markets are fairly priced in China, reflecting the uncertainty because, as we know, this is a big year as the year plays out with their forum. We don't think they're going to let the economy collapse a whole lot further.
And Mark, you speak with a certain authority here. BNP Paribas has an absolutely unique relationship with China going back to 1860. On my first trip to China, folks, I had the pleasure of, the honor really, of meeting with senior BNP officials and government officials in Beijing. It was a unique meeting. Mark Howard, does the United States risk ceding China trade and commerce to Europe? Is there a point here where Europe, and particularly BNP Paribas France, can be opportunistic and get a marginal edge in China?
Well, my good friend and colleague George Sun is the best person to ask about that because he's on the ground and he's watching the flows day to day. But I think that China is a global player, and they have bilateral relationships with all the leading trading partners, including those that have big financial institutions. I'm not sure that it's a regional opportunity or risk that you framed right now. I think rather it's in market by market, product by product. It's in the best interest of all global players to continue to support trade, even though there are tensions and frictions. The One Belt, One Road initiative and the variants of that create opportunity for European institutions and for African and for American, and I think that's going to continue to be the case. But certainly there are going to be fits and starts, and there are going to be periods where one country or one institution finds itself on the back foot temporarily. But the leading global players will remain, I think, committed to China.
Mark, I just want to pick up on something you said. I'm always interested in the language we use to describe China. They won't let it happen. Mark, that implies they have a greater degree of control over the situation, that it's up to them not to allow things to happen. To what extent do you think they actually have control over some of these dynamics taking place in this economy?
Well, it's not just the ability, but the willingness, Jonathan, and that's why I phrased it that way. There are certain circumstances like the housing and the property markets where they have the ability to pump things up. They have the ability to insert capital and stabilize financial institutions or construction companies by orchestrating the workouts of debt. We don't do that in the West. We don't do that in the UK or Europe. So that's one example of where they have clearly in the currency markets as well. And given the importance of export activity for them, they have the ability to maneuver their currency in order to support key sectors of their economy. And they use the regulatory switch rather aggressively too. So they have the ability to support some of their domestic exporters at the expense of other players. So I think they just do it more frequently, which in my opinion means that they're more likely to intervene and support growth and other priorities.
Hey Mark, good to catch up. Send our best to the team, won't you? Mark Howard there, BNP Paribas. Bramo, I think that's an important dynamic to think about in China, because if they do face what some people fear they face, which is some form of liquidity trap, they're not allowing things to happen. Well, it may be out of their control as to whether it happens or not.
Especially because Leland Miller yesterday was saying they really haven't put that much stimulus into the market. You saw a faded response to the stimulus they did start to put in.
We'll build on some of this conversation around China. We'll catch up with Tina Fordham in just a moment of Fordham Global Foresight. Futures up 0.2% on the S&P. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The US says that a nuclear deal with Iran is closer than before, but gaps still remain. A State Department spokesman says Iran has appeared to drop some of its, quote, non-starter demands. The Biden administration continues to review the EU's latest proposal to revive the agreement curbing Iran's nuclear program. Hedge funds are unleashing record bets that the Federal Reserve will stick to its hawkish script at Jackson Hole. The group has collectively placed a big short across futures for a key overnight rate that moves in line with the Fed's benchmark. That position will benefit if Fed Chair Jerome Powell effectively rules out a dovish pivot when he speaks at this week's symposium. And the price of U.S. natural gas rose above $10 per million BTUs for the first time since 2008. That extends a rally driven by concerns that global stockpiles aren't enough to meet winter demand. In the U.S., inventories are well below normal after summer heat boosted electricity demand. Meanwhile, production has grown only modestly. And life expectancy in New York plummeted by 3 years in 2020. The CDC says that was the biggest decline among all states in the first year of the COVID pandemic. Residents of New York are expected to live to just under 78, the 15th highest life expectancy in the country. Overall, U.S. life expectancy plunged by 1.8 years in 2020. That is the biggest drop since World War II. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
If you do any kind of business in this country, there's a pretty good chance that you're going to see that business registered in Delaware. Why? Because that's where you do it. And our point was Wyoming can be that venue for blockchain enterprise, for crypto.
It's not the Wyoming way to sit around and wait for change. We want that independence, we want that freedom, we want that individuality. And that's a common theme that brings together bipartisan support for this in Wyoming.
We want to make sure that people understand, especially in Wyoming, but as the United States as a whole, this trend is coming. It's not going to stop. This is more of a small town that's growing into what I would call the cryptocurrency version of Silicon Valley.
It's the philosophy of that rugged individualism, the independence, and the ability to really get things done for yourself and control your own destiny. You get that from a blockchain, and you don't get that without it.
Top names at the Fed are on Bloomberg.
I have a baseline case going into September that is 50 basis points. That's where I've been since the last meeting. But I have an open mind about whether 75 is going to be necessary. 50, 75 doesn't just depend on a data point, even an important one like the CPI. I like to say that we're data dependent, we're not data point dependent.
Nobody covers the Fed like Bloomberg, your global business authority.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
seeing increasing downside risks to the European economy. Naturally, what's going on with the natural gas situation is a key contributing factor there. And so we're targeting 97 on Eurodollar. We think that there's more weakness to come for the euro and more strength to come for the dollar.
As Matt Hornback and Morgan Stanley looking for that weaker euro. We've had 4 days of it now on Eurodollar. From New York City this morning, good morning. Tom Keene, Lisa Abramowitz and Jonathan Ferro. Futures up just a little bit. Let's call it 0.2% higher on the S&P, 0.25% higher on the NASDAQ 100. I've got to get used to quoting this, 99.27.
I'm not, you're like, wait, there's a typo.
Where's the other number? It's gone. We're negative 0.16%. That's more euro weakness out there and some more dollar strength, Tom.
It is. Right now, let's get to this because I think it's so important. It's a bit away from what we're doing in the markets. John and I will do that with foreign exchange here in a moment. Sterling 117.62. But on the fracture of international relations in Europe and the unspoken, Tina Fordham joins us right now, founder and geopolitical strategist at Fordham Global Foresight. I look, Tina, at where we are and the bombing in Moscow and all that, and there seems to be an unraveling. In our world, it is the parabola of energy prices. In your world, it's something like Ms. Meloni in Italy with not fascist, but certainly very austere tendencies like what we see in Hungary. How unsettled is Europe given the energy price overlay?
Well, Tom, you've highlighted some of the themes that are interwoven really in the global political risk outlook, where those high energy prices you mentioned, of course, are being driven by the continuation of the Russian invasion of Ukraine, which shows no sign of abating, plus the long-standing Kremlin policy of intervening in European politics. It's not illegal, first of all, for European political parties to actually take funding from other countries. And furthermore, this is long documented. Viktor Orban's connection to the Kremlin, Matteo Salvini, who's on the record today from the Lega Nord party in Italy, saying that perhaps sanctions against Russia aren't working. So while policymakers and markets are, rightly focused on the kind of harrowing inflation outlook, which is taking up the reaction function and the attention, these cracks are really concerning. And the September elections in Italy are going to put a prime minister in office who is uncomfortably close to fascist tendencies and with connections to Russia.
I mean, the shock of the pricing is so tangible. There's got to be, my reading of history here, and it may be 1938 on to whatever, you can pick your point of gloom, but the fact is this pricing leads to international relation and political adjustment. What would you suggest that adjustment will be?
Well, at the first level, it's going to lead to enormous household distress. And I see that through the lens of what's happening here in the UK with the leadership contest for the Tory party and the talk about the energy price cap. We're talking about households seeing a quintupling in their energy bills. A normal household paying, over £1,000 a month for electricity. It's a shock that is not going to be able to be absorbed. So first of all, I think there's going to be mass non-payment. And if you look at the dynamics of the Tory leadership contest, it's all about getting those 160,000 Conservative Party voters. It's a different platform. So this government is going to be reactive. By contrast, Macron in France has been more proactive, saying it's basically the patriotic duty to kind of deal with it. And we have to stay strong in the face of Russia. I think that Europe's resolve when it comes to supporting Ukraine will continue, but there's going to be a lot of pain. This is going to hurt. And you asked what the kind of policy response is going to be. People look at the pandemic and they're going to expect government support. How we get there is very hard to say. But the public won't be able to absorb price increases of these proportions.
Tina, you went where I wanted to go, which is you said that the resolve will remain strong to support Ukraine, to battle Russia, and that the European people will continue with that message. When does that fray, especially as power costs rise and there is an increasing chorus of people saying perhaps some of the sanctions and some of the measures taken against Russia were as penalizing to the Western nations as anyone else?
Well, I mean, it's always a question, right, of what's the alternative? And there's no going back to Russia as an energy supplier. Those days are over. And the substitution of supply is already happening. We are, however, looking at a very difficult winter here, one that people aren't used to. You know, in the old days, at least you had a fireplace and you could chop firewood. Now it's central heating, which means people are going to have to turn it off. So it's going to be incredibly difficult. But what you do see in Europe is an increasing sense that Ukraine has to win this conflict. There isn't going to be a turning back from that. But I guess what I'm trying to say is that maintaining that position of support and the sacrifice that it's going to entail for households means you have to accelerate the green transition. You've got to keep those nuclear power plants going, which is a huge turnaround for German policy. And that's happening rather quickly. Not quickly enough to alleviate pain this winter, but I think quickly enough. And again, we can't go back to Russia as a dependence upon Russia as an energy supplier. They're not a dependable source.
These are huge, huge changes we need to try and adapt to. Tina Fordham of Fordham Global Foresight. And Tom, I really want to pick up on that. I think we're all struggling collectively to process some of these numbers and some of these moves. And we haven't even started to think about the so-called second round effects of all of this. Yesterday, we talked about Citi's forecast for inflation in the UK maybe peaking at 18% in January. It just feels like a number we're throwing out there, Tom, without even really thinking through.
I totally agree.
What on earth that means. And Tom, I'd go a step further. I think we have a relationship with the barrel of oil in a way that we don't have a relationship with the gas price. I can tell you gas prices are up by 40% or so in Europe on the month. But Tom, I don't think we really understand what that actually means for the European consumer this winter.
Yeah, and this is really important, and that it's part of what we're doing at Bloomberg, and, you know, the invention of surveillance and all that, John, is by definition, we're removed from all this. But to your point of second order effects, at the second order, the second round, if you will, as time moves on, things change. And where Tina comes in and others in international relations is trying to look to the past and the ghosts of the past and say, what's different this time? And that brings an urgency to the fourth quarter of this year that we haven't seen in ages. These are parabolic moves, John.
Huge moves, Lisa, and really complex issues.
And they're trickling out to just beyond the Eurozone. You're seeing natural gas in the U.S. also surge to the highest level since 2008. So becoming global, raising that issue, how divergent can these economies really be?
We'll catch up with an economist next. Jan Hatzius of Goldman Sachs, coming up in about 5 minutes' time. From New York, this is Bloomberg.
Apple's delaying its next major iPad software update, iPadOS 16, by about a month from September to October. Apple made the decision for a number of reasons, including a still buggy Stage Manager multitasking interface and in order to link the launch closer to the more similar macOS Ventura. Still, it's an unusual move. Since shifting the launches to the fall in 2011, Apple has released its new iPhone and iPad software updates simultaneously each year around September. By staggering the releases, users may find some issues around compatibility with cross-device features like retracting and editing messages in iMessage, the new shared iCloud photo library, and the new feature for transferring FaceTime calls between iPhones and iPads. It will also make it a bit harder for developers to launch apps that run on both the iPad and iPhone that require new APIs and features found across iPadOS 16 and iOS 16. Regardless, it was still, of course, the right move. Stage Manager on iPadOS 16 is still quite buggy. I don't find it particularly intuitive, and it's not compatible with most iPads and many third-party apps on the App Store. The feature clearly needs some more polish. And complaints from consumers about Stage Manager will now no longer probably overshadow the earlier launch of the iPhone 14.
The markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
At the start of the internet revolution, I kicked up a lot of controversy declaring that the internet had been underhyped. I say the same thing today about the climate revolution.
Politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg.
The Fed and Powell in particular needs to get across the message that the job is not yet done.
It's not just about what the ECB does and what the Fed does. You have to take into account the market's inflation premium.
We're really playing a game where the market desperately wants the Fed to react.
We are still very much in the early days of recovering off of an extreme low.
Right now, central banks everywhere will take anything they can get.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Ramo's got things to say about Goldman HQ. I'm just going to share them a little bit. Like, seriously, maybe.
How are you
From New York City this morning. Good morning, good morning. For our audience worldwide on TV and radio, alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Futures TK positive 0.1%. It is all about the data in Europe, and it's the US next up.
It's about the data, the shock of looking at the Bloomberg terminal. We're going to review that with you throughout the hour and, frankly, throughout our trip to Jackson Hole and what we'll hear from Chairman Powell on Friday. John, I want to go to the Great Divide of America. This is something Jan Hatzius did years and years ago. Macy's just out, John, and buried in it is the comp sales at working class Macy's, negative 2.9%, and at fancy Bloomingdale's, where Mrs. Farrow shops, up 8.8%. That describes the divide of this nation.
The words you don't want to see from retail right now: markdowns, promotions, Lisa, inventory, aged inventory. These are big, big problems that we were hopeful that Target had worked their way through. Macy's, it just seems they're just starting.
The problem is that they actually beat expectations when it comes to sales. However, when it comes to their forecasts, they ratcheted them down because of the expectation of consumers slowing down their purchases. How do you get ahead of such a quickly moving tide of consumer sentiment and the post-pandemic reality, John?
Well, they've had to cut their guidance this morning. Futures right now positive about 0.1% on the S&P. Macy's just about positive as well. On the Nasdaq 100, up by 0.15%. If you take a look at the bond market, yields unchanged at just north of 3%. That's the breakthrough 3 we've seen in the last 24 hours. But the move in foreign exchange, Bramo, you've got to get used to it, haven't you? 99.24 on euro dollar. It's a clean break of parity in the last couple of days. We're down 0.2%.
I keep thinking about Jordan Rochester as 95, the next target here, as people expect that downturn in Europe to deepen with higher gas prices. What we're watching today, 9:45 a.m., we do get a series of PMIs out of the U.S. for manufacturing as well as for services. Although at 10 a.m., this is what I'm watching in terms of data. U.S. July new home sales. How much do you see activity in the home market really deteriorate on the heels of higher mortgage rates? At 1 p.m., the U.S. is selling $44 billion of two-year notes. This is fascinating to me, especially as people position for a hawkish speech from Fed Chair Jay Powell. How much interest is there going to be at two-year yields? Yes, you're actually getting something for cash. We've been hearing about that from Steve Auth and others at 3.3%. However, what is the risk of the Fed going much further and staying there longer than people are currently expecting? And we were just talking about Macy's. The earnings season is kind of dripping to its end here. We've got Macy's that just came out. Those shares up now 2.2%. They did beat on the sales. However, they downgraded their overall forecast. We also hear from Dick's Sporting Goods and Nordstrom after the bell. How much does Macy's really become the theme in terms of the mood going forward? What does it say about the consumer, John, at a time where they've hung in there for now, but there's the expectation that it is a temporary resilience that will fade?
That stock this morning hanging in there for now, up by a little more than 2%. Lisa, thank you. Joining us now, we get really lucky. Jan Hatzius, Chief Economist at Goldman Sachs. Jan, let's talk about it. China, GDP forecast over at Goldman now 3% for the year. Europe, base case for pretty much everybody, they enter recession. Jan, where on earth does that leave the US economy?
I think the U.S. doesn't have quite the same degree of headwinds as both China and Europe. In China, obviously, you have the zero COVID policy and the property market downturn, which is a multi-year development. In Europe, you've got the gas issue. There's nothing quite to the same degree that we have in the U.S., but it's going to be a slow growth environment, below trend. The Fed wants below trend. That's why financial conditions are where they are, because the Fed's tightening pretty aggressively, and you've got the fiscal drag. So plenty of headwinds for sure, but I don't think it's quite as bad as in China or the euro area.
How do you expect Chairman Powell to navigate that, Jan, this Friday?
I think he'll be balancing between two things. One, I think he will lay out a case, as he did at the last press conference, as they did in the minutes, for slowing the pace of increases. We had 275 basis point moves. Our expectation would be, barring significant data surprises, that the September move is 50. I think I don't think he'll be specific about the number, but I do think he'll be saying, there is a risk of over-tightening, and therefore it makes sense to go a little bit more slowly than these really outsized increases. But at the same time, he'll make clear that the job is not yet done. Inflation is way too high. They're very committed to bringing inflation back down to 2% or thereabouts. So I think it will be a balancing act.
Yeah, and there's a mix here of themes, and one of them is what we just saw from Macy's, where Bloomingdale's and the haves do well, and Macy's and the have-nots really are struggling. Or it could be John Taylor of Stanford visiting with Bloomberg in the last 24 hours, saying sustain, sustain, sustain a higher yield environment. Are we getting our x-axis wrong right now? Do we need to look out 2 years, 3 years, or 5 years of elevated inflation?
I think a year from now, or 2 years from now, inflation will be much lower because there are some drivers. I mean, commodity prices are clear. The goods sector in general, I do think that's going to come off a lot. The risk is more on the services side, where we've seen less of an indication that things are slowing, especially rents are still growing very quickly. So I think that's still going to be well above normal, into 2023 and maybe even beyond. So I do think that there are going to be improvements, but not everywhere.
Should we have a more nominal GDP, nominal inflation analysis, witness the haves and the have-nots? The have-nots are getting crushed minute by minute. Should we switch to a more nominal study?
Well, I think what you're suggesting is that we look at the distribution of incomes and spending, and you clearly see some big differences there. And I think, Macy's versus Nordstrom's is a good example. You can look at real income at the top end, at the bottom end of the income distribution. There's been a much bigger pullback at the bottom end, in part because the fiscal support was so much more important there, and that's come off, and in part because at the bottom end, you see more of an impact from gas prices and inflation generally. At the margin, the drop in gas prices obviously is helping somewhat more at the bottom end, but that's only a small part of the previous deterioration.
There is, however, Jan, at least with physical goods, a bit of a disinflationary pressure, whether it comes to inventories or some of the commodity prices that have come off. Is it enough to achieve a soft landing? Have you actually improved some of your forecasts about what the Fed has to do and the outcome in the U.S. economy?
I think it's certainly helpful, and we've continued to be in the softish landing camp, in part because of the expectation that some of the goods pressures would abate. The most important factor, though, is adjustment in the labor market. That's something that they need to pull off, and I think we've seen some encouraging indicators, in particular the 1.1 million decline in job openings that we've seen in the JOLTS data, which is probably still underway. We'll probably see some further significant declines there. That is starting to bring the labor market into better balance. Still early days. We still have a large gap between jobs and workers, but at least we're moving in the right direction there, and I think that's going to be key to sustain it.
Do you think that the market right now is not reflecting what still has to be done, though, from the Federal Reserve in order to achieve that? And this is something that we've heard about throughout the morning. The theme of the day has been that stocks need to wake up to it. That is the bearish tilt. Do you agree with that right now they are not accounting for the pain?
I think the terminal rate pricing doesn't look too low. I mean, it's sort of 3.5 or a little bit more. I think that is sufficient relative to our forecast, maybe even a little bit more than sufficient. Where I would disagree more with market pricing is the pricing for significant rate cuts. I think that certainly could happen and would happen if you went into a recession. But I think in a slow growth environment where the Fed is trying to squeeze inflation lower, I think they'd be very resistant to rate cuts. So I do think that those cuts are probably somewhat excessive from a market pricing perspective.
It's a raise and hold strategy, in the words of San Francisco Fed President Mary Daly. Jan, have you got any idea of how you think they will hold rates at that kind of level? For how long? Is it too early, too premature to have that conversation?
Oh, I think it could be a couple of years. I mean, really? If you get to the mid threes or maybe even a little bit higher, and then you stay there, because I think while inflation will look a lot better a year from now, I think it'll still be significantly above the target, and ultimately they do want to get back down to pretty close to 2%.
Jan, that is totally out of consensus. How much pushback do you get from clients when you bring that up?
I think it's away from market pricing. I don't know if it's as out of consensus in terms of what forecasters are saying. I think there are quite a lot of forecasters and Fed officials. I mean, you just mentioned President Daly. Fed officials who are saying that this is a reasonable baseline.
John, squeeze one more question in here, because the bottom line here is simple. This is the theme of Jackson Hole.
But I think this is the difficulty.
This is the theme.
Jan, 3.5%, if you're going to hold rates at that kind of level, and it could be, I stress you said could be, a couple of years, where does a soft landing fit into that kind of profile, that kind of rates profile?
Well, I think that is a soft landing kind of assumption. If it wasn't a soft landing, if you went into a recession, then I think you would get cuts. But if growth stays at 1%, 1.5%, labor market continues to adjust, inflation gradually comes down, and the Fed in that environment keeps the funds rate relatively high, I think that is a soft landing.
Absolutely fascinating. Yeah. I think we'll continue this conversation. Jan Hatzius at Goldman. Jan, great to catch up, sir, as always, with Tom Keene and Lisa Abramowitz. And I can see Lisa at the corner of my eye with things to say.
So much.
Things to say, and not on Goldman's HQ, where it's located, but more just on, can you imagine, Lisa? 3.5% for a couple of years.
I'm looking at investment-grade bonds. The all-in yield was below 2% not that long ago.
You'd have to imagine, to Jan's point, that growth has to hold up for that to happen.
Yeah.
Do markets need to readjust in a different way? Is that what you're suggesting?
Well, we can have a discussion. This is a fascinating one.
The future's unchanged on the S&P from New York City. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Gasoline prices in the US have now fallen for 70 days straight. That's the most in more than 7.5 years. According to the Auto Club AAA, pump prices are averaging $3.89 a gallon. That is after reaching a record high of around $5 in mid-June. There are signs that fears of a recession in Europe may be coming to pass. Economic activity in the Eurozone fell for a second month. August's drop was driven by manufacturing. Still, the post-lockdown rebound in services like tourism almost ground to a halt. Consumers have been hit by big jumps in both energy and food costs. The U.S. warns that Russia is about to launch a new round of attacks against Ukrainian government facilities. Ukraine's preparing to celebrate its Independence Day on Wednesday. President Volodymyr Zelensky says that Russia, quote, may try to do something particularly nasty. Credit Suisse is now focusing more on wealth management while it's making cuts to its troubled investment bank. The Swiss bank is reassigning advisors to its private banking international unit, which goes after high net worth clients. That is according to an internal memo seen by Bloomberg. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today. It's going to be short-term.
Bloomberg Markets, The Close. Weekdays on Bloomberg.
Access the financial world on demand.
Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This week, as the world watches inflation rise, employment rebound, and fiscal policies react, all roads lead to Jackson Hole for the Kansas City Fed's 2022 Economic Policy Symposium. Bloomberg's all-star team is live as policymakers and financial insiders discuss the economic issues and solutions that keep the world's money moving. Coverage starts August 25th on Bloomberg Television and Radio.
Things are a real mess. There's no growth momentum anywhere in Europe. The only place where I can see any growth momentum coming through before the end of the year is probably in the US, and even there it's going to be patchy, but it's nowhere near as bad as it is in Europe, and I think that the US is going to avoid recession quite comfortably.
I needed that calming, soothing music to promo Jackson Hole before Ian Shepherdson of Pantheon turns around and just says things are a real mess. Tom Keene, Lisa Braverton, Jonathan Ferro. Futures basically unchanged on the S&P 500. Two really tough days for the equity market bulls over the last 2 days on the S&P 500. We've been lower by around about 3.4%. NASDAQ futures up around about 0.1%. In the FX market, the euro dollar 99.27. We're down another 0.1%. It's 4 days of euro weakness. And Tom, more weak data out of Europe this morning.
We need to pause on this, John. The bid it gets stressed here about every 20 minutes with DXY out over 109. Greg Anderson at BMO Capital using BBDXY is, well, John, I don't even know what to pick here other than sterling had a difficult 3 a.m. and now euro 0.9925 is challenged.
We need to pick up on the conversation we just had with Jan Hatzius of Goldman Sachs, who essentially told us that the hurdle for interest rate cuts next year is much higher than most people think. He also posed the idea, Tom, that maybe you get to about 3.5% and you stay there for perhaps 2 years. That's something that we've not discussed, Tom, in a material way at all.
Well, I've been talking about the x-axis. It's not my job to opine on this. We'll leave that to Dr. Hatzius and other worthies. But, John, I just think it's one outcome that has to be considered at the absolute minimum. And as you and I said earlier, this has got to be, it's just got to be, to me, the core theme here at Jackson Hole leading up to the chairman's speech on Friday. Again, John, we're there Thursday. It's you, me, Grizzly Bears, Lisa, 3 Elks.
I thought you were calling Bramo the bear, the market bear alongside us.
I'm actually going to have a bear suit on.
Actually, that would be great. We could get a photo of her next to the 8-foot grizzly bear in the lodge there.
Okay, we'll make that happen.
Which one's
But that's the big divide we need to discuss on Friday, Lisa.
Yes.
The big divide between a market saying rate cuts, let's go in 23, and some people like Jan Hatzius and the Federal Reserve, for that matter, saying, hold up, hold up.
Well,
we might be holding for a while.
It's the good and the bad of a resilient economy. The good is that it's resilient and that you avoid a recession. The bad, at least for some investors, is that the Fed could keep those rates at that level for longer without torpedoing the momentum. And that's something people haven't really discussed.
We'll have to see on this. Right now, futures a little bit elevated, not quite as elevated as earlier. Right now, quickly, Joe Matthew from Washington. Joe, get out the map. Moscow straight south to Crimea is 1,100 miles. All Putin cares about is Crimea over to Odessa, which is 360 miles. Triangulate this with President Biden in Washington. All of a sudden, what's changed is Crimea is discussed. That was unthinkable, Joe, 2 years ago.
This is very true, and we're seeing this virtual meeting now with delegations from 40 nations trying to put pressure on Vladimir Putin over Crimea. I imagine that he thought this was said and done here, but there's a lot of concern about tomorrow. We're going to be talking about Independence Day in Ukraine and what that might mean for Bridget Brink. Remember, the U.S. ambassador to Ukraine has only been there for a couple of months now. Our diplomatic presence in the capital could be very much at risk if Vladimir Putin, to the point of President Zelensky, who you see right now, could try something cruel, could try something unusual in attacking the capital city on what, of course, is a day of celebration for Ukrainians. So this is a very touchy situation right now as we look across the rest of this week, remembering, of course, that that's the 6-month mark as well tomorrow. This war is 6 months old. We were told that Kyiv would fall in 3 to 5 days when it began. And we're reading stories here on the terminal of the Russian military, again, that is bogged down, and a Ukrainian military that is inspired by the effort to protect its homeland in a remarkable way. Is this going to be something we're talking about 6 months later? That could bring a very different wrinkle to the Crimea story.
And we all hope that it gets resolved sooner in a way that avoids some of the carnage. Joe, we've been talking about the resilience with Tina Fordham, the persistent feeling in Europe that this is an important cause, even as gas prices rise dramatically, even as the pain is borne at home. Is the same true in the United States, as a lot of the surrogates for Joe Biden, whether they like it or not, go out and take to campaigning?
Well, it is for now. The question is, how long can this last? When does the war fatigue set in? When are the louder questions about spending billions of dollars to support the effort in Ukraine? It's actually quite remarkable that there has not been a larger cry, more isolationist view, particularly from members of Congress. But the Biden administration has held true to its promises so far for President Zelensky and the people of Ukraine. Where are we going to be, though, post-midterms? Where are we going to be as we go into the winter heating season? Those are really important questions. The reaction here in the United States could be very different from what we see in Europe.
Joe Matthew, thank you. Looking forward to the show a little bit later. Sound on Bloomberg Radio weekdays at 5 p.m. Eastern Time. That stat on gas prices, Lisa, is just amazing, isn't it? Was it 70 days?
Yeah, just amazing.
And still going.
It's still going, and you have seen that completely fall off, even as you see natural gas. We're talking about gasoline, which has come down for 70 straight days, versus natural gas surging around the world.
Why can't you just call it petrol, then we wouldn't get confused? Wouldn't that help out?
That's un-American, John.
I'm sorry.
That's very un-American.
What do you want me to call it? Aluminum?
Okay, all right.
It's also
have I upset both of you?
Like, what is this? So why don't you just call it petrol? We call it gas.
I had a conversation with my producer this morning.
A gas station. Do you call it
talking to Jamie at his desk, and I said, well, yeah, you can't say that because people will get confused.
Where's my intern? Can we get some therapy for those two?
Versus natural gas.
They both feel vulnerable.
I mean, is it, in all seriousness, John, in the UK, do you call it a petrol station?
Yeah, it's a petrol station.
Really? But that's so long.
So it's where you get petrol from.
No, it's gas.
It's gas. Okay.
John, can I parse what Hatzi has said?
Of course you can.
The sustain here is not a static sustain at, say, 8% inflation. It's if we come down, and it's totally unacceptable for Lawrence Summers and for anybody at the Fed on the other side of the debate, at 3% or 4% or 5%, that's the then what? And that's where you get into the 3-year regime.
You've raised it a few times, Tom, and I totally agree with you. We're talking about a Fed pivot just because we've seen year-over-year inflation peak potentially a little north of 9%. Lisa, it's a big change.
Well, and this is the reason why people say that there is no pivot. I want to go back, though, to what Jan Hatzius is saying. Basically, his implication is that this economy is a lot less interest rate sensitive than people thought, that it can withstand a 3.5% to 4% interest rate for a prolonged period of time without getting torpedoed. This goes against the conventional wisdom of the low rate whole decades, and I find that fascinating.
Does he call it petrol, though? Find that out.
He doesn't.
Find that out.
No,
that's the important piece of this.
John.
Yeah.
Is this what you're going to die on?
John,
really, petrol?
No, I couldn't
come
care
off
less.
set Thursday, and if they're still serving, we're pivoting to the Huckleberry pancakes at the Pioneer Grill.
I've got to go on a diet, Tom.
Oh, they're low-cal.
They're low-cal?
They're low-cal.
Low-cal pancakes.
Or at least they told me.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
The difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
The markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
2 days of losses on the S&P 500. The last 2 days down by about 3.4% on the S&P. This morning, just in and around unchanged on the S&P, positive 0.04%. Similar move on the Nasdaq 100. A lot of the pain, the contribution from the front end of the bond market, I think. Let's look at 2 years together. 287 at the start of August, getting really close to the intraday highs of the year of 345. Right now, about 333. Yields up by a couple of basis points to 332.92, and the prospect that maybe the Fed does raise and holds, Tom, at 3.5%, there and thereabouts for a couple of years, according to Jan Hatzius of Goldman Sachs. TK, that's the big divide as we go into Jackson Hole. People looking out to 23 and talking about rate cuts and a Fed not saying anything about it.
And Anna Wong of Bloomberg Intelligence and Economics adamant that we're going to go much, much higher than maybe Hatzius' center tendency. I'd also suggest John Taylor of Stanford University was forceful with Bloomberg a number of hours ago and just saying, look, we've got to normalize at any cost, and that cost, of course, can be slowdown.
2 questions, Tom, and they're the right ones. 1, how resilient is this economy? And 2, if it's not that resilient, how tolerant will this Fed be of any weakness? And that really means you have to ask yourself the question, Tom, how high is that hurdle for rate cuts from this Fed?
And I would say, John, that hurdle, going back to McChesney, Martin, and Truman, is a political hurdle. I'm sorry, this will get to a point where politics will invade the discussion.
It's not clicked in just yet, that's for sure. When unemployment starts going the other way, Tom, I'm with you. But with the payrolls number we just had a few Fridays ago, that was a very different picture.
Did I do okay there?
You did brilliantly, Tom,
okay, thank
as
you.
always.
I'm watching Man U highlights.
Yesterday, I didn't do so well with my football prediction. Let's look at foreign exchange. The best tweet I've seen over the last few days is just a China euro dollar, a break of parity, and the title, Tom, is it's called soccer now. Do you like that? So I guess
that leads to the power of the U.S. dollar here.
Dead wrong, Tom. Yeah. Dead wrong, as Man United get it done. But TK, we've got to get used to this. 99.25. We had Matt Hornback and Morgan Stanley yesterday say 97. Jordan Rochester saying maybe 95 over at Nomura. There's some big calls.
There's some, I always go, I'm genetically going to go to EM analysis on this. And, you know, there's certain EM economies that are actually doing pretty good here. It's a developed economy, a developed pair headache right now. But with that said, maybe we do what we always do, John. Watch yen. Yen has not weakened yet.
If you want an EM feel, talk about sterling, 117.68.
Stunning.
Just about unchanged, but numbers that, Tom, I didn't think we'd be talking about through much of this year, I have to say. And 97.95, I say they're big calls, but at 99.22 on euro dollar.
It's a cup of coffee away.
Basically there. maybe a few sessions away. That's the foreign exchange story, the cross-asset picture. Let's get you some single names. We can do that with Lisa. Hey, Lisa.
Hey, John. If you want an emerging markets feel, take a look at Bed Bath & Beyond's shares. They have been all over the place, losing 60% in 3 trading days. A little bit of a rebound today, up about 4% in revenge of the memes. AMC, I got hammered yesterday because people were saying the huge declines that we had been seeing were not because they were lumped in with the meme stocks, but it was because of Cineworld and their bankruptcy over in the UK, number 2 theater operator, as well as, and this more importantly, preferred shares starting to trade. You're seeing a little bit of a rebound there, not much. There's a big question about live audiences getting back to it in the post-pandemic era. Zoom shares down 11.5% in pre-market trading after downgrading their sales forecast yesterday after the bell. In terms of earnings today, we just got Dick's Sporting Goods, and we did see them beat expectations as well as raise their full-year forecast. You're seeing a pop in those shares in response, 2.3% gain. Macy's up at 2.1%, even though they actually came out and downgraded their forecast, but people were expecting this. To me, that's fascinating. So people are rewarding their beat, rewarding what their delivery was, even as they say, look, it's going to get worse from here. And Nordstrom shares up more than 1%. They report after the bell, Tom.
Lisa, thanks so much. Greatly appreciate it. Long ago and far away, short-term paper in the short-term trust market was either commercial paper analysis or LIBOR analysis. Winnie Caesar knows this, global head of strategy at Credit Sites. Winnie, I want to start with the gloom that's out there, the stew of Bloomberg surveillance. And the joke we make is it's a toxic brew. The toxic brew out there now. What are we going to learn from the short-term trust market, what we used to call the LIBOR market? What's the toxic brew you see right now in short-term paper, or is it all calm?
Well, I'm not sure about a toxic brew. The front end of the market has clearly had some pretty significant challenges trying to assess exactly where the Fed is heading, seeing a lot of the leveraged loan markets, which it's referenced away from LIBOR towards SOFR. There's a lot of different headwinds going on in the front end of the market, and that's just made it for a really challenging kind of liquidity market more broadly. And then kind of pulling forward some of the big themes that's going on in the front end of the market, you just come to the shape of the curve. And that has been, a real challenge for economists, for corporate credit investors, just for pretty much everyone involved in the fixed income market.
Winnie, when I mentioned toxic brew and LIBOR, did that cause your baby to scream? Did I make a faux pas?
100%.
Okay, Lisa, pick it up. What I said was, I cause a lot of babies to scream. Lisa, pick it up.
Well, Winnie, a lot of people are screaming about the potential for interest rates. Did you like that segue or segue, as someone would say? When you talk about interest rates and how high they could go, and I want to go to this Jan Hatzius theme of perhaps not hiking rates as far as some people are projecting, the Bill Dudley-esque north of 4%, but at 3.5%, for a prolonged period of time. Has this economy become less interest rate sensitive than many people previously had thought?
Well, Lisa, that's a great question. And I think that a lot of it comes down to the shape of the curve in terms of interest rate sensitivity, especially when you look at the corporate credit market. Right now, we have very flat curves, which from a refinancing perspective is actually very supportive. If you are assuming that a company has a maturity that they then roll over into 10 or 30-year debt, the increase in borrowing costs is not nearly as significant if you're assuming that they're going to be just putting in place more 2-year paper and more 2-year paper. So I do think that you can't kind of overestimate